Term, but it does promise a mass market car by 2023. Matt?
All right, that was a little bit of a disappointment, I think, for markets as expressed in the pre-market trade of Tesla shares. Here you see the futures in Europe. We have gains across the board. FTSE futures right now more than 1%. French futures also are big gainers. If you take a look at the global macro movers screen, you see a slew of risk assets, each column dedicated to one specific asset. And in the far left-hand column, you'll see the equity indexes as the live cash trade kicks off. The FTSE gaining 0.6% right off the bat. The IBEX in Spain gaining more than 1%, which is interesting because you've got those increased restrictions in Madrid as well. British stocks quickly climbing to a gain of more than 1% as French stocks open at that level as well. So you're looking at more than 1% gains across London, Paris, and Madrid as we await the other European equity indexes to open up. And speaking of Spain, Anna, we've got the final GDP readings out of the country. It doesn't look good.
Yes. Yeah, it doesn't look good. I mean, if you're looking for a bright side, it looks a little better than anticipated, but it doesn't look good. It is the final reading, and it is a contraction, well, a drop in the size of this GDP in the second quarter, down by 17.8%. That's the quarter-on-quarter number. The year-on-year number, a drop of 21.5%. As I say, both of those slightly better than the survey, slightly better than how the number had presented previously, but this is the extent of the contraction we're seeing here, down by 18 or 21.5%, depending on whether you look at the quarter-on-quarter or year-on-year number. Let's get to Gregory Purdon, our Buthnot Latham co-CIO, who joins us this morning. And Gregory, we're going to get a number of data points for the European economy today. We get this GDP update from Spain. We're going to get some PMI numbers. As we head into the winter, what is it that you're looking for in terms of the growth story here in Europe? How resilient can it be, do you think?
Well, I mean, I think that the Europe, I mean, although it's a little bit the whipping boy in terms of the crisis, it's got a few tricks up its sleeve, and I wouldn't necessarily be too negative on the situation. I mean, one of them is the fact that a year ago, no one would have thought that Germany would have pulled the fiscal bazooka out, and they certainly have done that. And another story which is little talked about is the fact that I think also France is a little bit of a trick of its sleeve, a rabbit out of the hat, in that it's used to dealing with structural unemployment. And that's a situation which many Anglo-Saxon countries are not used to dealing with. So I'm not as overly bearish as many of our peers. I think it's very fashionable to be negative on Europe. And you couple with that with the fact that we really got, I mean, not unlimited support, but almost unlimited support from the ECB. And I think Lagarde and co. has been very clear about that.
All of those positives, though, Greg, we had last week. And this week, we're getting some negatives in banks like Goldman Sachs are saying they want workers to go back home. We're just getting another headline from HSBC, the biggest European bank, saying it wants most workers to continue from home as well. So these increased restrictions are kind of the new news. How does that change your strategy?
Okay, and that's a very fair question. I mean, the way we're looking at it right now is that we're still in a healthcare crisis, which is transformed into an income sheet crisis, but it has yet to transform into a balance sheet crisis. And I think if we do see that tipping point where the income sheet starts to dramatically transform into a problem with the balance sheet, which is what we saw during the GFC, then I think we're going to have to put the tin hats on. But for the time being, the level of support we're seeing out of fiscal and monetary is just stupendous. So that's one of the reasons why I'm struggling to be, too bearish in this scenario.
Yes, and with that in mind, we've had some lines from Dominic Raab, the Foreign Secretary, this morning, doing the rounds in UK media, and he seems to be giving more explicit guidance that the level of support for the jobs market in the UK is currently under review by the Chancellor. Clearly, he's been called upon by many people to extend in some form the furlough scheme at the end of October. What do you think should be on his agenda? What should he be looking at, Gregory, given the conditions that have been put on life over probably the next 6 months? How is the Treasury going to support people through that?
Okay, look, we in the UK, we are facing the prospect of a messy Brexit. We're facing the prospect of an uptick on unemployment and the prospect of flu season. So, I'm not a political, scientist, but I would venture to say that there will be some form of extension on the furlough scheme, which is perhaps a little bit more directed at the industries which are going to be the most hardest hit. And without that type of reaction, I think it would be very difficult for us to then turn around and weather the storm over the course of the next few months. So that would be my expectation, Anna.
I'm just, excuse me, I'm just seeing headlines here that Navalny has been released from inpatient treatment at the Charité Hospital here in Berlin, and that doctors believe Navalny will be able to experience a full recovery. That just strikes me, maybe because I'm here in Berlin and he's here in Berlin, as pretty exciting news. And I wonder what you think about, we talk about the COVID crisis. You've got the US-China issues and Brexit, of course. But you've also got this emerging problem with Russia, slowly but surely emerging with the Nord Stream issues and the alleged poisoning of Navalny. Are you concerned about that at all getting to be a bigger issue, Greg?
I think that there was a little bit of a turning point when Merkel came out a little bit more strongly towards, Russia. My understanding is that Merkel and Putin speak on a regular basis. She speaks Russian, and that, that was really a point where almost like a point of no return. From a portfolio perspective, I'd be cautious to suggest that that's taking too much of a impact in terms of how we're positioning. But certainly Russia is on the radar screen in the sense that because it falls within the EM complex, because it falls within the commodity complex, and obviously as a multi-asset manager, we need to be looking at the emerging market currencies, how we think oil and natural gas is going to play into portfolios. So certainly an eye on it, but I wouldn't go so far to say that it's directing some of the energies in our IC.
Gregory, thanks. Stay with us. Gregory Purdon, Arbuthnot Latham, co-CIO, with us this morning on the European Market Open. 6 minutes past 8 here in London. Coming up later on Bloomberg, the Fed has shelled out $8.4 billion buying fixed income ETFs. So how did Jay Powell do? And what about the investors who tried to get ahead of him? We'll discuss that in our weekly show, ETF IQ Europe. That's at 9:30 a.m. London time. This is Bloomberg.
I think that it is likely that more fiscal support will be needed.
I think the next package should be much more targeted. It should be focused on kids and jobs in areas of the economy that are still hard hit.
The recovery will go faster if we have both tools continuing to work together, as they have so far, I think worked very well together.
We're inclined to allow for additional flexibility on the money that's already gone out to state and local governments.
We need to reopen the economy so people can go back to work, and we need to do it in a sustainable way.
Just watching there, Fed Chairman Jerome Powell and Treasury Secretary Steve Mnuchin testifying before the House Financial Services Committee. And it reminds me to tell all of you, wearing your mask only on your mouth and not covering your nose isn't really the point. You've got to cover both of those things in order to stop the spray and stop the spread. So I just wanted to say that publicly, and now I got a chance to, given this position. Now, the U.S. has averted an October 1st shutdown. The House passed a stopgap funding bill to keep the government operating through December 11th. That's after both parties in Congress and officials at the White House struck a deal to provide aid to farmers and food assistance for low-income families. So that's some good bipartisan news there. But otherwise, it isn't a very bipartisan look in Washington, D.C. these days. Greg Purdon, Arbuthnot Latham, co-CIO, is still with us. And Greg, we've got a real split, I think most importantly to markets, in terms of the need for fiscal stimulus, further fiscal stimulus. What do you expect? What do you think the U.S. needs?
Okay, I mean, put it very crudely, the way I look at it is that the Fed will look at the credit market and the bond market, and the White House will look at the stock market. Because the stock market is much more optical. I mean, the average guy on the road in America knows what stocks are doing, but generally doesn't know what the bond market's doing. And if the bond market's functioning and issuance is happening and bonds are being traded and there's liquidity and price discovery, then the Fed is happy. And also there's the credit spread angle. So I think that if we start to see some real red in stocks, probably that will motivate the White House to try to get some sort of package through pronto. That way it placates, the complaining voters. But the reality is that, until that, ultimately, Trump will use his usual playbook. He'll play to the crowd. And so far, they've been able to get away without having to come to the negotiation table and find some sort of agreement between the different parties.
So maybe the Powell put should actually be the White House put then, Gregory, from what you just said there. When we look ahead to November, do you expect a great deal of volatility? Clearly, some of the options pricing suggests that the market is expecting some volatility around the election. And interesting to see over what period that volatility starts to build and then continues.
I'm not being contrarian just to be contrarian, but the reality is that both candidates are pro-business. And so I would expect a high level of volatility if it was Sanders versus Trump. But the reality is that Joe Biden, okay, fine, he's a Democrat, but he's actually not anti-business. I think actually the second derivative question is going to be if he does win, okay, how is he going to fend off the ultra left within his party to then turn and try to put forth anti-business policies. I think that will be the struggle. But in terms of the actual, Trump versus Biden, they're both pro-business, and that should be, relatively supportive of equity prices.
If I'm not mistaken, Joe Biden drives a big block, naturally aspirated Corvette. So that should tell you a lot about the man. I have respect for that. Let me ask what you think about the U.S. relationship with China, because Obama-Biden didn't really stir the pot the way Donald Trump has, but it can't be unstirred now. What do you think if we get a Biden presidency? And I know that, that's still a big if, but how does that affect the U.S. relationship with China?
I mean, one of the things that's quite surprised me, we did a lot of work on China about 2 years ago when we published a big report on the New Silk Road. We took a position in the A-share market and so on and so forth. One of the things that surprised me is that I'm not surprised by the fact that China's been, hawkish towards the U.S. because they're just defending themselves, politically and philosophically. What I've been a bit surprised by is that China's now taken a much more confrontational stance towards some of its other developed nations, like the EU, for example. And the reality is that I think the flight path of a distancing with China and a confrontation with China and the U.S. is probably a flight path that's not going to go away, regardless of whether it's a Trump or a Biden. I think the semantics and the drama and the theatrics around it will obviously be much more different. Biden will be much more of a diplomat around it, and Trump will obviously use the typical saber rattling and Twitter attacks. But ultimately, it does seem like the U.S. and China are not going to be on very good terms for some time.
If we could just pivot back to Europe, Gregory, we've got some breaking news coming through from France. French September manufacturing PMI 50.9. The forecast not far away, 50.6. So that's above 50 and not far from forecast. On the services side, though, things starting to look a little weaker. The services PMI falling to 47.5. The forecast 51.5. So I suppose this is interesting because it perhaps taps into a narrative we're going to revisit in the months ahead, and that is in European economies, services being hit, and perhaps manufacturing being able to weather at least some of the storm.
Yeah, and I mean, there's a bit of a paradox there because, ultimately the developed nations are all gravitating towards service economies and away from manufacturing. And actually, in a period like this, we're seeing manufacturing, continuing the momentum. And ultimately, the momentum in Europe is slowing. I mean, there was a bit of a ricochet, and that ricochet, like you just correctly pointed out, Anna, we're seeing the service number you said below 50, which ultimately is not ideal. That having said that, you saw the announcement from Macron, what was it, 10 days ago, about the green check writing that he's going to be doing. Let's see if it happens. There's always a big spread between the announcement and what's shovel ready and so on and so forth. But ultimately, there is a tremendous amount of political will in France and in Germany to cut checks and keep the train going in the same direction. So that's one of the reasons why I'm not terribly bearish and would probably forecast consolidation in the European equity complex over the course of the next few months.
All right, Greg, great spending some time with you today. Thanks so much for joining us from your home office. Greg Perdon, Arbuthnot Latham, co-CIO. Greg is going to continue the conversation with us on Bloomberg Radio this morning as well. That's at 9 a.m. UK time, 10 a.m. on the continent. So if you want to tune in the city, just go ahead and listen to London DAB, Digital Radio, Bloomberg Radio on that platform. Otherwise, you can just Google it, find us on the internet. Let's get the Bloomberg Business Flash. For that, we go to Laura Wright in London. Laura?
Thanks, Matt. Tesla is setting the lofty goal of making a $25,000 car by 2023. The cheaper car will be possible by innovating electric car batteries and cutting the costs in half. The news comes as part of the company's so-called Battery Day, but it did lack the sizzle investors have come to expect from the CEO, Elon Musk. Amazon is telling Echelon Fitness to stop selling the Prime bike, an exercise bike promoted as a collaboration with the company. The e-commerce giant says it's not an Amazon product or related to Amazon Prime, and that they're working with Echelon to clarify and change the product branding. No comment yet from Echelon. TransferWise says its annual profit has more than doubled as it attracted millions of new customers. The money transfer business has seen a boost from cross-border transactions, which drove a 70% increase in revenue, over a quarter of which now comes from the US. In July, the closely held firm was valued at $5 billion. That's your Bloomberg Business Flash. Matt, Anna.
Thanks very much, Laura. Laura Wright here in London. Coming up, Prime Minister Boris Johnson sends a stark warning to the public as the UK tightens coronavirus restrictions once again. We're live in the city with details of what that means for those who work here. This is Bloomberg. Welcome back to the European Market Open. 21 minutes past 8 here in London, and you can see that European equity markets are moving to the upside this morning. We sold off to such an extent on Monday in fear of further lockdown measures, and now we spend the rest of the week sort of recalibrating expectations there, perhaps a little bit, also digesting the latest Fed and ECB thoughts. With the ECB in mind, interesting to see this development in markets. We now see Italy's 30-year bond yield falling to the lowest on record. It is still interesting to see the bond yields continuing to fall, even as we have a little bit of an expression of dissent from Yves Mesh, talking about how the exceptional flexibility that has allowed the ECB to buy so much Italian debt through its pandemic bond buying, how he doesn't think that that should be applied to other QE plans and projects and schemes at the ECB. So that's something we are certainly watching. Now, the UK Prime Minister Boris Johnson has appealed to the public to go along with new restrictions to combat the spread of coronavirus. Britons have been asked to work from home where possible. Bloomberg's Danny Berger is in the City of London, and she's been taking the temperature and testing people's thoughts, getting a handle on the atmosphere out there. What have people been saying to you, Danny?
And basically everyone I've spoken to, it was heading into work. This idea that Boris Johnson's plea would make a big difference, at least on day one, we're not seeing that. You can see behind me, still plenty of people on their way in commuting, riding bikes. Some of the buses I've seen, those do actually look pretty empty, only 2 to 3 people in them per bus. But still, I spoke with one person, Greg White, who works for a recruitment agency, and he told me that his firm is full. They're still implementing social distancing measures. They have hygiene stations everywhere. So his firm, they want that collaborative effort, so they're still going in unless Boris Johnson tells them that they absolutely can't. I also spoke to someone who works in real estate here in the city, who is also on his way to work, saying that his office over the past few weeks has been pretty full. He does expect that to change slightly as people, as he, in his words, want to do their job, their contribution for Britain. But he was going in for a meeting. He says that in circumstances like that, he'll still think that people will go into the city for those sort of face-to-face interactions. Again, it is crowded in terms of what it has been maybe in August and some of the summer months in the height of the lockdown. Sadiq Khan, for his part, the mayor of London, says that there might be more restrictions needed for the city itself, and warned of the economic trouble coming for the city, and some of the businesses here, he said, might need a bailout.
Danny, what about businesses that needed a bailout in the last crisis but don't need one now, banks? How is this impacting their plans? Because a lot of them were eager to get workers back to the office, to get bankers back in their towers, and now they're sending them back home again.
Yeah, Matt, even eager to the point where banks like JP Morgan commissioned a study finding that their employees were less productive at home. So no word yet on what JP Morgan's plans are, but for banks like Goldman Sachs, they've told their employees in the Plumtree Court office, which is just under a mile from where I'm standing, that they no longer have to go in. Now, it was at about 20% capacity before, so it's very likely that that number will start to dwindle. Goldman, of course, being one of the earliest and most aggressive banks in terms of getting their traders back. We've also just moments ago learned that HSBC is stopping their plans for a phase 1 of getting people back into the office. They still are going to have some of their more critical workers and the small number of branches open, but they've said otherwise stay at home if you're not going in. Even for one-offs like going to pick up a piece of equipment, they said employees can no longer do that unless it's an exceptional circumstance. They've also had some pilot programs testing how they would do different events like planning meetings. HSBC has also halted those.
Danny, thanks very much. Yeah, really interesting to see whether we start to see a more complex picture emerging depending on the role you have, how much regulation might require you to be in a certain location to do your job on an ongoing basis. I know that's something that certain parts of banking have been dealing with. Danny Berger out on the streets of the City of London. Thank you very much. Let's get to our movers. Adidas, shares in Adidas. Interesting to see this stock on the move, up by 4.75%. Others in the sports space also trading higher. JD Sports in London also higher. Nike jumped as profits soared beyond expectations for the US rival. Osram also in focus. The Osram share price up by 13% right now. AMS making a bid for the remaining shares to finish its takeover. And Genmab, the Danish biotech company, that stock is down by 11.5% after it started arbitration with Johnson & Johnson over royalty payments. Matt?
All right, up next, Boris Johnson, as we all know by now, has appealed to Britons to obey the virus rules, even reinstated some and put some new restrictions on. We'll hear from the opposition when we come back. Labor's Rachel Reeves joins us next. This is Bloomberg. Welcome back to Bloomberg Markets. This is the European Open. We are 30 minutes into the trading day right now. Let's take a look at the PMIs. First off, out of Germany, September services PMIs here falling to 49.1. The forecast was for 53, so that's a big miss. Manufacturing, though, a big beat, 56.6. And the forecast was for 52.5. So Germans are good at making stuff, but they're not very good at serving things. If you live here, you totally would understand that. Let's take a look at the story so far in terms of the stock 600. You can see if you look at the equity index, it's gone higher right now, up 0.8%. Coming down just a little bit, but if you look at the breakup in terms of the industry groups by using GRR, group ranked return, you can see that that almost all of the equity index industry groups are gaining. Only basic resources is a loser today. Now let's get the Bloomberg First Word News. For that, we go to Laura Wright in London. Laura?
Thanks, Matt. Fed Chairman Jerome Powell is calling for further support for the U.S. economy, saying it has a long way to go before fully recovering from the pandemic. He made the comments during testimony to the House Financial Services Committee. Prospects for another round of fiscal stimulus have dimmed in recent days amid tensions over a replacement for Supreme Court Justice Ruth Bader Ginsburg. On that note, President Donald Trump's plans to replace the late Justice Ruth Bader Ginsburg are gaining momentum. Republican Senator and Trump critic Mitt Romney says he supports moving forward with a confirmation vote. That's all but quashes the Democrats' hopes of stalling a nominee until Inauguration Day. President Trump plans to announce his pick on Saturday. Presidents Donald Trump and Xi Jinping clashed during a virtual United Nations General Assembly meeting. The U.S. president used his speech to accuse Beijing of polluting the oceans and lying to the world about coronavirus. His Chinese counterpart hit back, slamming leaders who tried to politicize the virus. As the race for a coronavirus vaccine continues, the Washington Post reports there will be new rules for emergency authorization. It says the U.S. Food and Drug Administration will bring in tougher standards that will make it difficult for the drug to be cleared before Election Day. The new guidance is expected as soon as this week. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Anna, Matt.
Laura, thanks very much. Laura Wright here in London. Now, the UK government has tightened measures to combat the spread of coronavirus. Britons have been asked to work from home, and from tomorrow, pubs and restaurants will have to close by 10 p.m. Prime Minister Boris Johnson appealed to the public to obey the new restrictions to avoid another national lockdown.
And to those who say we don't need this stuff and we should leave people to take their own risks, I say these risks are not our own. The tragic reality of having COVID is that your mild cough can be someone else's death knell.
Prime Minister Boris Johnson there. Let's hear now from the opposition Labour Party. We're joined now by Rachel Reeves, Shadow Chancellor of the Duchy of Lancaster. Rachel, very good to speak to you this morning. So I've heard from the Labour Party over recent days and in fact weeks that you want to support the government in what it's doing. You want to reinforce public health messaging, all of which, you know, we understand. But does it look, are you in danger of looking as if there is no opposition when it comes to deciding just how tough to be on this virus?
Well, we support the new restrictions on who we can meet and where and when. But there are three additional things that we believe the government should do to help get this virus under control. The first is ensuring we have a proper test, trace and isolate system. The government promised one that was world-beating. We would be happy with one that just functions right now because, frankly, the system is on the verge of collapse. Second, along with the restrictions on our movement package that was announced yesterday, we need a package of economic support. With businesses being told they have to close earlier, with new restrictions on when and where we can meet, an economic package is essential, and we've been calling for some months now for a flexible furlough scheme, something that the Bank of England governor also seems to be supporting. And third, we need local support for areas that are particularly badly affected. And the combination of those measures, along with the additional lockdown restrictions that the Prime Minister announced yesterday, I think stands a much higher chance of getting control of this virus again.
And so, Rachel, if the Chancellor is watching and he's trying to decide which bits of the economy he should continue to support with the follow-on scheme to the furlough after the end of October, where would you be drawing lines? Because this is going to be difficult, isn't it, to work out exactly which sectors of the economy have been most affected. Clearly, there are obvious parts, but then there will be others, supply chains to those hard-affected bits of the economy, for example. Where would you draw the lines?
Well, that's what we're calling on the government to make the system flexible, to support those businesses and jobs who particularly need the support. There are parts of the economy, for example, in performing arts, in hospitality and in aviation, where there's clearly a massive problem now with job losses and business failures. There are also particular parts of the country who are under greater lockdown rules that might need additional support. And we're urging the government to look at that and put in place a package of measures, because it is the wrong thing to pull the rug from under people's feet at this time when the virus is still prevalent in all of our communities, endemic in some of our poorest communities, and before the furlough scheme has been able to see through people during these difficult times.
How full is your constituency postbag or email inbox with business leaders, businesses in your constituency telling you that they are worried about going under? How much of a presence is that concern?
Well, about a year ago, I set up a small business group in my constituency, so I'm in regular touch with small businesses and larger businesses in my constituency. And many of them are very worried about the future and very worried about those who work for them in a whole range of industries. And that's why, one of the reasons why, I think it is so important that the Chancellor comes back with a package of measures, a flexible furlough scheme, to ensure that no more jobs and businesses are lost than is absolutely necessary. The government, by withdrawing this furlough scheme too soon, risks a further wave of job losses and business failures that this country can ill afford.
Rachel, when we went into this thing, it didn't seem terribly wise to pile on people, and especially small and medium-sized companies, with debt while they were earning no revenue. There was a lot of talk then about the possibility of future forgiveness. Could you foresee a Labour government instating a jubilee, a debt forgiveness?
I can understand why some businesses are calling for that. I think we have to see the situation that we're in next year. But what I absolutely do not want to see is banks coming in heavy-handed, trying to get back the money that has been loaned out. The government have got to ensure that that doesn't happen. And banks as well have got a responsibility. They were bailed out during the financial crisis. They've got a responsibility to support, particularly our small businesses now. But the government need to assess the situation that we're in.
But state-backed coronavirus loans, do you think they could be forgiven?
I think we have to see the situation we are in next year. The longer that this virus persists and the longer it takes to get a vaccine, the more challenging it is going to be for businesses. So I'm not going to rule anything out, but I think that this isn't the right stage to make those decisions. We need to see what situation we're in next year, but it absolutely must not be the case that small businesses are asked to pay back money before they can do so. And banks and the government have got a responsibility to make sure that that doesn't happen.
Meanwhile, the UK dealing with Brexit negotiations, Rachel, or the future trading relationship, at least, across the channel. Our colleagues have a story out this morning, Rachel, that talks about how the UK government is itself warning of a 7,000 truck long queue or line in Kent in a reasonable worst case scenario for the end of this year. Michael Gove urging traders to get ready for controls implemented by EU member states by the 1st of January. Paint a picture for us. How do you anticipate, and this isn't even in a no deal situation, paint a picture for how you anticipate trade happening on the 1st of January.
Well, we need that free trade agreement with the European Union. It is in our national interest, and I believe it is in the national interest of every single country in the European Union. So I would urge the government here, but also our counterparts in the European Union, to stop the posturing and start negotiating seriously, because a shock to our economy on top of the pandemic and everything we're going through right now would be an awful thing to inflict upon British businesses and European businesses as well. So we need that deal. The government also need to put in the systems, the technology systems and many other things to ensure that businesses can be ready for whatever happens on the 1st of January. And the government today is saying businesses have got ready. Well, I would urge the government to get ready and ensure that the systems are in place. The government promised IT systems, they promised additional customs agents. Those things have not yet materialised, and that is putting huge pressure on businesses who are having to deal at the same time with the impacts of the coronavirus.
Thanks very much. Thanks for joining us. Rachel Reeves, UK Shadow Chancellor of the Duchy of Lancaster. Thanks very much for joining us there from the Labour Party then. Up next, here on the European Market Open, green finance. The ECB says it will start accepting bonds linked to environmental goals as part of its asset purchase programme. This is Bloomberg. Welcome back to the European market open. 8:44 in London. European equity markets make moves to the upside, up by 0.9% on the Stoxx 600. Now, the European Central Bank risks legal trouble if it tries to extend the emergency powers of its pandemic bond buying plan to its other asset purchase programs. That is according to the executive board member Yves Mersch. His statements come as the central bank also took a stance on climate change. The ECB announced it would start accepting bonds linked to environmental goals as part of its asset purchase program. Joining us now is Marie Desanis, who is head of EMEA at Northern Trust Asset Management. Marie, good to speak to you. And we've talked to you in the past about the green agenda, about ESG themes, and the news that the ECB is going to be buying green bonds. I suppose many in the market had assumed that, hadn't they, given that governments around Europe are going to be issuing so many of them. Does that come as a surprise to the market at all?
I don't think it comes as a surprise to the market. Right now, there's about $1 trillion issued globally, and investors are looking for particularly a focus on climate change. With greener investing in thematics, it's in line with the Paris Agreement and the commitments from institutional investors, the regulatory requirements that are evolving globally, and pressure from end investors to have investments reflect values. Europe alone, if you look, invested over $60 billion in climate-aware funds. So it's not a surprise that there would be interest and uptake on this.
Is there enough? Do you think there's going to be a lot more issuance? Because it looks like with the ECB as a buyer and with it being such a prevalent issue, that there's more room to grow in this industry.
There's no question that there's a need for inventory now, because it enables you to buy portfolios in mass. And with smaller issuance, you could have wider spreads or difficult to access in certain markets. And the industry has been looking for many ways to invest in fixed income, particularly with green products. So if we believe that your values are you want to have a green portfolio, you want not only your equities, but your portfolio in totality to reflect that.
There's been a big debate in central banking, the extent to which policymakers should try and shape in some way or buy into climate change policies, Marie. And I suppose it's not a great leap from where we are right now to think about the ECB doing a specific green quantitative easing. So saying, here's a pot of money and we'll only spend this on green bonds or bonds that meet certain ESG criteria. Would that be quite a game changer, do you think, for your universe?
So Northern Trust Asset Management has been involved in these dialogues. And if you look at the Recovery Fund, for example, the goal of the Recovery Fund is for climate neutrality, digital transformation, and social and employment support. So this very much aligns with how to get green recovery. It aligns with climate law, so getting a net zero greenhouse gas emissions by 2050. And it also aligns with the Green Deal, an action plan around the blueprint of how do we achieve that. The challenge is, though, with any recovery program, as you know, it's been hard hit because of the economic slowdown and the health crisis. And the contribution budget can vary by EU state. So no matter how they go about evolving that, they're still going to need to prioritize climate change and the digital efforts around it. I mean, clearly technology is the way forward as we're talking here today.
Yeah, absolutely. Where do you think we're going to see the biggest surprises, Marie? Do you think that the market's got some things wrong that are going to show themselves to be where we're going to have to do a 180 in 5 or 10 years?
No, actually, it's interesting. When you had me here before in 2019, I said it was the year of ESG. Early 2020, I said this is the decade of ESG. And COVID has actually accelerated sustainable investing. We saw the trade-offs with the E, so the environment. When we slow down travel and commute and less pollution, we saw that the country revitalizes, fish come back into the canals of Venice. We saw the importance in the workplace, safety, and taking care of people, and how diversity pays at the leadership table. And certainly from a governance framework, operational resiliency has been important so that business can run their KPIs and make their deliverables. So what we've learned, and we're getting right, is that ESG adds an extra lens for companies. Companies that have had good environmental structure and have human capital management and good governance, they actually can be a forward-looking indicator of the overall health of a company. So those are the things that I think are going to positively accelerate and thwart us into the right direction.
Marie, thanks for your time today. Marie Dezanis, head of EMEA at Northern Trust Asset Management. 10 minutes to the top of the hour. Coming up on the program, is growth outlook strong enough for risk? We will put that question to Mark Cudmore, our Bloomberg Markets Live managing editor. Is the growth outlook strong enough for risk? That's coming up next. This is Bloomberg.
Welcome back to the European Open. We are 52 minutes into the session right now and looking at equity indexes that are gaining 1.5% or more. So strong gains. Even in Germany, where we just had services PMI that missed the mark, although the manufacturing PMI outdid it by quite a bit. Let's get into the markets now with Mark Cudmore. He's our Bloomberg MLive managing editor in Singapore. And let me first ask you about the increased coronavirus restrictions. Mark, we're seeing that now in the UK. It's basically the third day that the markets had to deal with this UK situation, but in Madrid, you're also seeing lockdowns in certain neighborhoods, and you're starting to see fears that this could spread throughout Europe. Has it all been priced in?
I'm not sure it has been properly priced in yet. I think this is really a kind of a driver of sentiment rather than the real economic impact. One of the themes that we've seen this year is that kind of battle between stimulus and the real economy, and the real economy really dived in the second quarter, and then it's been picking up quite rapidly since then, and now we've hit the slower part of the recovery, or when the recovery is starting to stall. And just as that's happening, we're suddenly getting investors very focused on this narrative around a winter second wave, and I don't want to get into a debate debate about how valid this is on a health side, or whether it's more about testing, or whether it's a severe second wave or not. But the point is at least we're getting that narrative kind of confirmed in the kind of news daily at the moment, that there is this winter second wave, and yet we don't have that vaccine yet. So even though people are still very optimistic that we'll have a vaccine maybe in the fourth quarter or first quarter next year, that's going to be too late for what people are now saying is going to be a major second wave, or at least that's the theme we're trading this week.
We seem to have something sparking some optimism today, Mark. European equity markets moving to the upside. There was that big sell-off on Monday, of course. We've made up some of that ground now, yesterday and today. But we do see the dollar gaining, so it's not all risk on. What is the assessment of risk appetite, do you think, in today's session?
I definitely don't think it's risk on at all overall. I mean, we're just consolidating after some pretty large losses in the last couple of weeks across many assets. You know, whether it's tech to metal space, we have been seeing a theme of risk aversion in the last couple of weeks. And Monday was a particularly bad day for European equities. So in context of that, they're bouncing a little. And I think that probably is a good way of kind of showing that, you know, there's no need to kind of see this correction as like a major panic, a major turning point, you know, we're going to head back to the lows or anything like that. But it's also not likely to be over yet. We're not seeing an exuberant rebound yet. What we're seeing is markets are trading slightly weaker over September in a slightly volatile fashion, but nothing too wild. And I expect that theme to continue a little bit longer.
What are you hearing in terms of the question of the day, Mark? Today on the MLive blog, you're asking, is the growth outlook strong enough for risk? What's the answer?
Well, I guess it goes back to kind of what we referenced there a minute ago about this disconnect from markets and the economy. And everyone knew that, you know, stimulus around the world had successfully distorted that connection between the economy and markets. But it's not permanently broken. It's not that markets forevermore can trade in a completely different world to what happens in the economy. And now we're getting an environment where the recovery is starting to stall, starting to slow down a little bit. And therefore that's making, at the same time, we're kind of hearing that we're not going to get more stimulus anytime soon. And that's maybe people think that maybe markets have extended too far to where the growth situation is. Even though we're expecting economies to rebound next year, the world won't be back to where it was at the end of 2019 by the end of 2021. And that's quite a worrying fact for markets that continue to trade higher throughout a lot of this year.
Yeah, the 2 lost years, at least. Mark, thanks very much. Mark Cudmore, Bloomberg Markets Live Managing Editor. Don't miss a conversation with Fed Vice Chair Richard Clarida. That's coming up on Bloomberg Surveillance a little bit later on today. And, in fact, Bloomberg Surveillance follows this program. They'll take you through the trading year here in Europe and into the US. This is Bloomberg.
Hitting pause, Goldman Sachs and HSBC tell staff in London to work remotely, reversing course after the UK government appealed to Britons to head back home if they can. Temporary powers. The ECB's Yves Mersch says the central bank risks legal trouble if it tries to extend crisis-era flexibility to its regular bond buying. And Battery Day with no sparks, Elon Musk disappoints as Tesla fails to unveil any major innovations, but it does promise a mass-market car by 2023. Well, good morning, everyone, and welcome to Bloomberg Surveillance. I'm Francie Lacqua here in London. A lot going on in terms of news flow for this Wednesday. We also have the ETF show coming up, but we're getting also some breaking news in terms of PMI. This is for the euro area. It gives usually a bit of an indication on where we're headed in terms of economic prowess or not. September services PMI coming in at 47.6. That's below the estimate of 50.6. I remind everyone that, of course, if you get a figure above 50, it means that we're in expansion territory, which we're not. So European stocks across the board are still gaining. Now, partly this has to do with some of the recent trends that we've seen, certainly when it comes to markets. The dollar also extending the rally, and it does seem that these stocks are steadying as equity markets try to build some upward momentum after we had a pretty big sell-off that cut valuations in September, early September. Now, coming up later today, the Fed has shelled out $8.4 billion buying fixed income ETFs. So how did Jay Powell do? And what about the investors who tried to get ahead of it? We'll discuss that, of course, in our weekly show, ETF IQ Europe. That's in 30 minutes from now. Now let's get straight to the Bloomberg First Word News. In London with me is Leanne Gerrans. Hi, Leanne.
Hi, Francine. Fed Chairman Jerome Powell is calling for further support for the U.S. economy, saying it has a long way to go before fully recovering from the pandemic. He made the comments during testimony to House Financial Services Committee. Prospects for another round of fiscal stimulus have dimmed in recent days amid tensions over a replacement for Supreme Court Justice Ruth Bader Ginsburg. Meanwhile, President Trump plans to replace the late Justice Ruth Bader Ginsburg. They're gaining momentum. Republican Senator and Trump critic Mitt Romney says he supports moving forward with a confirmation vote that all but quashes Democrats' hopes of stalling a nominee until Inauguration Day. President Trump plans to announce his pick on Saturday. Presidents Donald Trump and Xi Jinping clashed during a virtual United Nations General Assembly meeting. The U.S. president used his speech to accuse Beijing of polluting the oceans and lying to the world about coronavirus. His Chinese counterpart hit back, slamming leaders who tried to politicize the virus. As the race for a coronavirus vaccine continues, the Washington Post reports there will be new rules for emergency authorization. It says the U.S. Food and Drug Administration will bring in tougher standards that will make it difficult for the drug to be cleared before Election Day. The new guidance is expected as soon as this week. The U.S. House has passed a stopgap funding bill to keep the government operating through December the 11th. That's after a deal to provide aid to farmers and food assistance for low-income families. The bill now goes to the Senate. Its passage would avert a government shutdown just before the November 3rd elections. Global news 24 hours a day, on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. Let's kick it off with our top story. And the UK Prime Minister Boris Johnson announced new measures yesterday to prevent the spread of the coronavirus.
We always knew that while we might have driven the virus into retreat, the prospect of a second wave was real. In the last fortnight, daily hospital admissions in England have more than doubled. If we can curb the number of daily infections and reduce the reproduction rate to 1, then we can save lives, protect the NHS and the most vulnerable, and shelter the economy from the far sterner and more costly measures that would inevitably become necessary later on. I'm sorry that this will affect many businesses just getting back on their feet, but we must act. Unless we palpably make progress, we should assume that the restrictions I have announced will remain in place for perhaps 6 months.
So that was Boris Johnson yesterday. Bloomberg's Danny Berger today is in the City of London. Danny, are there less people about today?
definitely not, Francine. If you were to compare this to a week ago, it's almost no difference at all. We have been seeing people around this area. Currently, I'm staying across from the Bank of England, so this is a very popular intersection behind me where people will be commuting to work. So yes, the number of people has picked up. This is by no means what we would see, for example, last year around 9 o'clock, sort of the peak of people going to work. But most of the people I've been speaking to around here say that they're on their way to work and they have no plans to work from home. For example, one person I spoke to, his name is Greg White, he works for a recruiting agency, said that his office is full. They have social distancing measures, they have hygiene measures in place, so there's no real reason for them, they think, to go home. They're not going to go work from home, in fact, until they're told they have to by the government. Now, I also spoke with someone else who works in real estate saying that they still need to go in for meetings, but otherwise he expects less people to go into the office. Now, the scenes around me with people walking in, there are a lot of bike riders as well, might hearten the CBI, for example, to see. Britain's business lobby has warned that the most recent restrictions are going to be difficult for businesses to survive. Though we might see more restrictions come for the City of London, Mayor Sadiq Khan has warned that he might need to add some more restrictions and said that businesses around here might need more support, Francine.
Danny, what have we heard from banks about how it impacts their plans to return people back to the office?
Well, Francine, you and I have been talking about this for a while. Banks have been some of the more aggressive businesses trying to get their employees back into the office. Well, today we've learned that Goldman Sachs is putting those plans on pause in London because of this announcement of Boris Johnson pressing office workers to stay at home if they can. Their Plum Street Court office, which is about a 15-minute walk from where I'm standing right now, it was about 20% full, but Goldman says no need to come back anymore. They were really aggressive in the beginning, trying to get their traders and people who need that infrastructure back into the office. HSBC, we also learned this morning, has hit the pause button. They're no longer continuing their phase 1 plans of getting people back into the office, saying that even if you need to go in just to grab an item, that's not being allowed unless there's any sort of exceptional circumstance, Francine.
Interesting. Danny, thanks so much for the update. Danny Berger there just outside the Bank of England. Now let's get to another one of our top stories, and the ECB risks legal trouble if it tries to extend the emergency powers of its pandemic bond buying plan to its other asset purchase program. Well, that's according to Executive Board member Yves Mersch. Joining us now for more is Paul Gordon, who leads our ECB coverage, who also spoke to Mr. Mersch. So, Paul, what exactly is the significance of these comments?
I would say it feeds into a debate that looked like it might have been getting started. There were reports earlier this week that some governing council members think the powers of the pandemic emergency purchase program are very useful and could be used after the pandemic crisis, perhaps in the existing asset purchase program. Mersch has been at the heart of ECB policymaking since the birth of the euro. He's a lawyer and he is responsible for the ECB legal services, and he's warning of legal trouble if you go down that route. He's pointing out that the governing council always links the pandemic program and the special powers, the extra flexibility it has to the pandemic. That was in the monetary policy statement. It was in the legal text that went alongside it, and it's been in every speech since. So if you decide you're going to change tack, then you run a legal risk. So it's quite significant wording from him.
Paul, what does the economic outlook actually warrant, in terms of more stimulus? Would we get more stimulus in December?
Yes, of course. I mean, this doesn't rule out the ECB deciding the pandemic program needs to be bigger or last longer. Mersch isn't prepared to go that far at the moment. He said that the outlook for the economy is in line with current projections, which are pretty poor, an 8% decline in GDP this year and only a partial rebound next year. He did say there are signs that perhaps the outlook could be a little bit better than that, but this all depends on the health situation. It's what he called a major caveat to any projections. If the health situation deteriorates, not just infections, but also the burden on the health service, then that could derail those scenarios. And in fact, we saw today, as you mentioned, PMI numbers coming out, which were really very poor for the service sector, which is the biggest part of the economy in the Eurozone. So that is at risk, and it does mean, I would say, that more quantitative easing, more pandemic purchases could yet be announced, as economists predict, in December.
Paul, thank you so much for the update. Paul Gordon there, who leads our ECB coverage. Now, coming up, the much-hyped Tesla Battery Day fails to meet expectations, but it lays out a roadmap to build the first mass-market electric car. So we'll discuss that a little bit later in the program. This is Bloomberg.
It is critically important that the markets stay open in this time, as opposed to trying to take breaks in the middle. I think that that'll just push off the situation a little bit, but actually could create other pent-up issues if you do close the markets.
Economics, finance, politics. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now, we're just getting some breaking news out of JP Morgan. A lot of the banks that we know, and we've talked about it, have been preparing in the extent of Brexit, but also now maybe a hard Brexit, so no deal with the EU when they leave on January the 1st of 2021. We understand now JP Morgan is set to move $230 billion of assets to Germany in this Brexit shift. Now, what we know so far about JP Morgan, and we'll try and dig deeper and bring you all the details, is, of course, that they chose Paris as the European headquarters, but I guess for some of the reasons they need to actually transfer physically some of the assets that they have and manage, and they've decided to do that to Germany in this Brexit shift. So as soon as we find out more, we'll bring it to you, but in the meantime, let's get straight to the Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hello, Francine. Tesla is setting the lofty goal of making a $25,000 car by 2023. The cheaper car will be possible by innovating electric car batteries and cutting the costs in half. The news came as part of the company's so-called Battery Day, but it lacked the sizzle investors have come to expect from CEO Elon Musk. Now, HSBC is joining Goldman Sachs in poising its efforts to return to its UK office. That's after the government appealed to Britons to work from home to help combat coronavirus. The bank says critical workers supporting customers in branches will continue to do so, but that most staff will remain at home. Nike is bouncing back from its pandemic slump. The world's largest sportswear market returned to profit for the quarter, posting far better revenue than expected. That was helped by growth in China and sales via e-commerce. Nike rallied in late trading, giving a boost to other activewear companies as well. And that's your Bloomberg Business Flash. Francine.
Leanne, thanks so much. Now let's turn to diversity and the topic of women in leadership. The former Prime Minister of Australia, Julia Gillard, and Ngozi Okonjo-Iweala, who's running to be the next WTO chief, spoke to Anne-Marie Hordern about the obstacles women face on the road to becoming leaders.
We need to increase the pace of change. I think we need to do two things. The business of politics has been structured around men's lives, not women's lives. So we need political institutions, political parties, the system of politics to reach out and embrace women and to change, to make it a profession that you can engage in, balance work and family life. And on that, I think Jacinda Ardern in many ways is showing the way forward. Second, we've all got to get out of the backs of our brains sexist stereotypes, which mean when we look at women leaders, we tend to project on them baggage that they shouldn't bear. We're more interested in their appearance. We're more interested in their family structures. We're quite predisposed to concluding that they're unlikable, even a bit of a bitch. So we need to get those sexist stereotypes out of our head and give women a fair run for leadership.
I recently interviewed the two women who wrote the report about how women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries be willing to elect female leaders?
I hope so, and I think we're having a very good debate about female leadership arising out of the data that those researchers have brought to the fore, showing that countries led by women are faring better during this dreadful pandemic. I'm always a little bit careful here. We can't kind of bake the sexism in and say, look, women leaders are always going to be more empathetic or always going to be more nurturing, because that is, you know, sort of weaving the gendered stereotypes through. But the fact that women leaders are being lauded in this pandemic, the fact that we are re-evaluating the importance of caring work to our societies, we know who has got us through, and disproportionately the women on the front line, the workers on the front lines in caring professions are women. And the fact too that we've got real experience now with this world of work, and we could take with us the best of it to enable work and family life to be better balanced. If we want to, we could come out of this pandemic era turbocharging gender equality for the future.
May I add something?
Yeah, sure. Add for sure.
I'd like to add something to what Julia said. And if you look at these women, there's also something that is important. They've built trust with their societies over time. Solving the problem of this pandemic also has a lot to do with trust. Your society trusting what information you give them, your society willing to obey and do things for the public good when you say so. So I think the women leaders, if you look at their careers, have also built up a level of trust.
Ngozi, on glass cliffs, you've said that women are only given leadership roles when things go wrong. 2020, a lot of things have gone wrong. How much of a problem do you foresee glass cliffs this year and the next, 5-10 years to come?
Well, thank you. Well, we actually say it tends to be the case. There have been some women who've had leadership roles when things were going right, but you notice a lot that women are given an opportunity when no one else wants to do the job. And we have this unusual year of the pandemic causing not only health problems, but also economic problems. And in some countries, it's going to be really dire. In fact, in many countries all over the world, the economic consequences are really severe. So it will be interesting to watch what will happen in countries where the politics gets more fierce and more murky or more difficult, and who will come forward. Will women then have a chance to come in and say, or will people vote for women to lead? We'll want to watch that and see what happens. I'm now looking, even in the run I'm making for the DG of the WTO, the WTO is not without challenges. And it will be interesting to see what happens with the election of the leadership. Is it going to be a woman? I always say you shouldn't elect a woman unless they are competent. So let's see if a competent woman will be selected.
That was Julia Gillard, former Prime Minister of Australia, and Ngozi Okonjo-Iweala, candidate to be the WTO's next Director General. Now, coming up, we hear what the Chief Executive of the world's biggest brewer had to say about the UK lockdown and what it means for the beverage industry. We'll hear from Carlos Brito, the AB InBev Chief Executive. This is Bloomberg.
Now some countries are talking about some restrictions, but not really a full lockdown. So you just had the pubs in the UK will likely have to close at 10, but they're still open. Pubs also learn how to live with social distancing. So they were able to put tables outside and sidewalks and everything. So the mayors allow that. So I think there's societies trying to work together in partnerships because the problem is a big problem. And the only way to bridge this and solve this will be through partnership. So mayors have to allow bars to expand their footprint so they can have customers come in, so people can have their social activity and be sane, but with social distance. So I think, and we're helping our clients also weather the storm. So for example, during the lockdown in the UK and many other countries, we did what we call the vouchers. So if you like your pub, Francine, that's close to your home, you could buy vouchers during the lockdown. We would match 1-to-1. That voucher would be working capital for your pub to survive during the lockdown. And then when the pub reopened, you could redeem that voucher with food and drinks at your favorite pub. So we try to facilitate and connect consumers with their favorite restaurants and pubs so they would help the establishments go through this tough period and be there when the situation would come to a new normal.
Your catchphrase has really been, beer bringing people together. If people can't be brought together, if you can't see your friends, do you think you'll have to produce less beer in 2021?
No, I don't think so. I think consumers will find a way. Of course, we don't know because if pubs are again shut down 100%, that's a different story altogether again. But I mean, if there are restrictions, but consumers, of course, are smart and they'll learn to live with those restrictions, I think some occasions will migrate and people, instead of staying till midnight, will stay until 10, will arrive early at the pub and will go from the pub to home and continue as a smaller group at home. So I think consumers will find a way because at the end of the day, when you think about the human being, us, we're a consequence of millions and millions of years of the way your brain is wired, the way we evolved as a human beings. So, I mean, we need social interaction, physical social interaction. There's so much that, there's only so much that Zoom can replace, but at some point people have to be together again. And that could be in the home, it could be in the pub, or, in smaller groups or bigger groups with social distancing or wearing masks all the time. But people will always try to go back to what brought us here.
Well, that was the AB InBev Chief Executive, Carlos Brito. In the meantime, JP Morgan moving about 200 billion euros from the UK to Frankfurt. This is because of Brexit, so we'll have plenty more on the story. This is Bloomberg. another day of risk off across the financial markets, we bring you special coverage of all the price action and implications here on Bloomberg Television.
I was actually poor.
No foreplay?
Eat your bag of Lay's with a smile on your face.
If all the diseases have been taken, I'll take a tax.
Welcome to Bloomberg ETF IQ Europe. I'm Francine Lacquen. Over the next 30 minutes, we'll bring you your guide to the region's thriving market in exchange-traded funds. Everything you need to know about the funds and the flows. It's 6 months since global stocks hit their bottom as the world readies for more coronavirus restrictions. How should ETF investors prepare? The Fed piles in, buying $8.4 billion of exchange-traded funds since May. So how did Jay Powell's investments turn out? And what about the investors who tried to get ahead of him? And as some of the world's biggest asset managers face criticism for their climate change voting records, we'll ask if passive can really be green. So let's take a look. First of all, first thing is first, at which countries and sectors have been attracting the money. Danny Berger has been analyzing the numbers. Hi, Danny.
Hi, Francine. That's right. I'm looking at FFLO Go, and this looks at funds that track different European assets. And for the past 5 trading sessions, we've seen net inflows at about $51 million. Now, the #1 flow-getting region over the past week is Germany, with $53 million going in. Now, that fits this narrative we've been hearing with the PMI numbers just coming out, with a stronger German manufacturing sector bouncing back. So you might see some of the inflows having to do with that optimism over the region. Though I do really want to concentrate on what's the bottom one down here, United Kingdom, with $31 million worth of outflows. Now, a lot of this, the majority of it, has come from a gilt fund, but we've also seen a lot of domestic UK funds get outflows, because if you're betting on this region, you want to be in the more international names if you assume that the pound is going to be weaker, and that's going to hit some of the domestic companies to the benefit of the international ones. So FTSE 100 ETFs, for example, we've seen inflows. FTSE 250 ETFs, one run by iShares and Vanguard, both saw outflows over the past week. Of course, in the UK, there's also the story, and really Europe as a whole, over the rising coronavirus case counts, more restrictions in the UK as well. So that might be turning some of the negative ETF sentiment we're seeing here as well. Now, finally, I just want to touch on Switzerland. They saw $10 million of inflows over the past 5 days. Now, part of that also might be because of the weakening currency. The Swiss franc headed for its lowest level since 2017. That's its worst quarter, rather. Of course, moves around the central bank, thoughts that the S&B will hold pat in their next rate decision, sending the currency lower. So maybe to the benefit of some of the bigger companies in Switzerland in those equity tracking ETFs, Francine.
Danny, thanks so much. Our Danny Berger there with some of the flows. Now joining us is Alan Higgins, Chief Investment Officer at Coutts. Alan, great to have you today with us. What jumped out in the ETF space in the last 5 trading sessions?
Sorry, Francine, I just missed that. The Zoom didn't quite come through. So could you say that again?
So I was just asking you what jumped out at you for market movements over the last 5 days.
Okay, now loud and clear. So for me, actually, it was probably something in the US, the big outflow from high yield that we saw. And if you had a chart on that, if you pulled up a chart on Bloomberg of inflows and outflows to high yield, it actually turns out to be quite a good contrarian indicator, together with the level of spread. And obviously, if you extend that, for example, to March, you'll see some horrible outflows, i.e. sales of high yield in March, where they had a double whammy, where investors were selling at very wide spreads and also at that time at big discounts to NAV. So Yeah, that intrigued me, and if we see any more of that with somewhat wider spreads, that could be an opportunity.
We definitely saw a correction in technology stocks over the last couple of weeks. Is that set to continue, Alan? And what does that mean for the ETF space?
So that's long overdue, Francine, a correction in equities generally, but especially growth technology-orientated areas. In terms of ETFs, it's more of a US play, as we know. So to a certain extent, this big option buying, whether it be from Robinhood type traders or the likes of SoftBank, some of that hedging will be in ETFs, some of it will be in futures. So the fact that that's become a little less hot will lead to some natural outflows. So yeah, I wouldn't be surprised to see some more money come out of tech, because people still have huge gains. So the NASDAQ orientated or the technology orientated ETFs, I can see some money coming out there.
Alan, in terms of what's going to happen from now until the end of the year, what are the things that you would watch out for that could actually move the ETF space?
So, despite what a lot of people think, we do actually see a V. And if you look at consumption data globally, retail sales, you are seeing that. You're even seeing in some countries retail sales ahead of last year. So if that persists, notwithstanding what we've just seen here in the UK, for example, and we do believe that, of course, like a lot of people, there will ultimately be a vaccine, and therefore it makes sense to bet on extended V, notwithstanding what happens in the short term, ultra short term. For us, it's will investors go to more value-orientated ETFs? So, for example, at Coutts, we've been very specific. The last major investment we made was in a US bank ETF. We're not brave enough to touch European banks right now in terms of an equity. We're more in the credit space there. But we put a substantial amount of money in terms of US banks ETFs, and essentially on a look-through basis, you're buying a big chunk of JP Morgan at pretty attractive valuations there. So yeah, some of the heat might come out of, if you like, the 3Qs, the NASDAQ orientated, the technology orientated ETFs, and more money going to value orientated strategies like we've just done in banks, US banks.
Alan, thanks so much. Alan Higgins there from Coutts stays with us. Now, coming up, the world's most important central bank has bought $8.4 billion worth of exchange-traded funds since May. So how did Jay Powell's investments turn out? And what about the investors who tried to get ahead of him? We'll bring you the story next. This is Bloomberg. is Bloomberg ETF IQ Europe, everything you need to know about the funds and the flows. I'm Francine Lacqua. Now let's take a look at the week's winners and losers. Here's Danny Berger with your ETF leaderboard. Hi, Danny.
Hi, Francine. Well, a really fascinating leaderboard this week, and I really want to hone on one trade it was clear that some or one large investor made, and that's moving into a currency hedged for the pound version of the S&P 500. So there are a lot of ETFs out there that will hedge currencies. The idea behind it is that you help alleviate some of the volatility. So that was the best asset getter this week. It's a Lixor fund. But the interesting thing I want to point out here is that you want to buy a pound hedged ETF if you think the pound is going to strengthen. That would probably go against conventional wisdom at the moment. We have seen a weaker pound regarding the Brexit discussions. If those are to turn sour, people have been selling off the pound because of that. But still, again, this is a bet on not just U.S. stocks, but a bet that the pound will be stronger. We also are having deja vu with physical gold coming in at number 2 as the flow getter over the past 5 days. Physical gold, this is an Invesco fund, so it means if you're getting your ETF delivered to you, you're going to get the actual physical product of gold. Now, some of that might be uncertainty over fiscal stimulus, but still more certainty that we're likely to see easing measures from various central banks. And finally, the last one there, an EM local government bond, an iShares bond, coming in at 3rd place in terms of flows. Now, if we look at the loser board, I can show you the flip side to that pound hedged ETF inflow. That number 2 there, it's also a Lixor fund. So same manager here, same S&P 500 bet, but again, it's a currency hedge one. So one that protects you against swings in the pound and presumably is a bet that the pound is going to go stronger. You also see 2 corporate bonds outflows here hitting the top of the leaderboard. In the U.S., as Alan mentioned earlier, we've seen U.S. junk bond fund flows coming out the worst in quite a couple months as $1 billion was pulled on Monday itself. Credit nerves have really been showing up in the ETF space. Again, some of that risk-off attitude we've seen in various markets. The equity picture is so closely tied to the credit picture, a lot of correlation there. So perhaps no surprise that we saw investors pull out money from both European and U.S. corporate bond ETFs, Francine.
Dan, thanks so much. Now let's focus on fixed income. And just since May, one institution has bought $8.4 billion worth of exchange-traded funds invested in bonds. Now, the institution, of course, is the U.S. Federal Reserve, but has the world's most important central bank done well with the purchases? Well, joining us now on the phone is Athanasios Psarophagis from Bloomberg Intelligence. So, Athanasios, great to have you on the program. What sort of return did the Fed actually get relative to other investors?
Hi, Francine. Good morning. Yeah, so the Fed, their purchases have stopped this past month. So, like you said, they bought about $8.4 billion. That is worth now about $8.6 billion. So, in an absolute dollar amount, they're up about $230 million on this portfolio. On a percentage basis, that's about 2.5%. I mean, one thing I think it's important to note is that the Fed, when they were coming in, they weren't coming in as a trader per se, right, being tactical and really essentially trying to make money on these positions. They were trying to prop up and support liquidity in the bond market. But what I think is who the real winners were was when the Fed announced that they were going to be supporting the bond market in March. They didn't actually make their first purchase until May. In that 2-month period, you saw about $24 billion come into these 16 products that the Fed is currently owned. And if you look at the average gain of those ETFs, since that time, they're up on average about 20%. So you actually see who the real winners were a lot of these front runners that probably up on average about 20% versus when the Fed actually came in and they're up about, the Fed, like I said, up maybe about 2.5%. So there was a lot of front running going on right after the announcement in between then and then the Fed's actual first purchase of an ETF.
So, Athanasios, you say basically that they bought no new ETFs in August. Why did they stop the purchases?
Yeah, good question. So they, like I said, it's worth about $8.6 billion. Total flows into those products are about $74 billion since the announcement. I think one of the reasons they stopped was I think the job was done. They've showed that they've made good on their word. They said they were going to buy ETF. With this initial investment, it looks like that the support was there for the bond market, or at least for the ETFs. On the second note was originally they did mention that they were going to stop buying in September. So it looks like they're holding true to that. And lastly, what they're starting to do is transition away from the ETFs and actually buying individual bonds. So they built this index. So they're moving away from that and buying the individual names. And I think that's really interesting because eventually what you have to realize is at one point they're going to probably have to sell these ETFs, right? So like we saw front running on the way in, it'd be interesting to see if people catch wind of a sale of the Fed of these ETFs. Do we see front running on the way back? So I think that's one of the reasons why we saw the Fed stop purchasing this last month.
Thank you so much, Athanasios. There was the very latest, of course, on some of these ETFs bought by the Fed. He's Athanasios Porofagis. Now, still with us, Alan Higgins from Coutts. Alan, thank you so much for sticking around. When you look at the fixed income space, what opportunities can you still see, if any, in ETFs?
So, yeah, it was interesting. Apinosis was it said talking about front running. I thought it was a bit strong because not, you know, the managers, investors were going in still taking risks, but he was right certainly in highlighting how late the Fed was to the party in terms of getting its act together. So where we are now, so as the numbers show, the big money has been made in investment grade. Nevertheless, if you look at spreads, so not yields, spreads are about average, maybe a little below on a long-term basis. So it's not a bad investment from a spread perspective. Unlikely to see the big gains, more like, if you like, Federal Reserve Board type gains going forward. I think that makes sense. We mentioned earlier high yield. I was intrigued to see this huge outflow because we've seen it time and time again. When you have these huge outflows, kind of fast money, discretionary, trading orientated, they tend to be only right over 1 or 2 days. And they tend to, if you like, look back in regret and think, oh my, why did I sell at such a attractive level? So we're not there yet, but I think high yield could get interesting. Combination of continued equity market turbulence, high yield spreads widening, some panicky sells. I'd be focusing more there.
Do you worry about liquidity in high yield?
So, yeah, I mean, ever since I've been an investor, I mean, I started as back in the day as an institutional bond manager. So this is, you know, my space. High yield has always been a liquid. To be fair, ETFs came through the March-April period, albeit we saw big discounts to NAV and very, very difficult times to trade. Certainly at Coutts, you know, we had, even in the equity space, we had market makers saying no to us in March, April. So it was a very tough time, even in equity. So liquidity in high yield, I mean, ideally, it doesn't suit ETFs or even T+3 funds. Ideally, investors like Coutts should be locked up a bit more to own high yield. But that's a much longer discussion.
Alan, thanks so much joining us today. Alan Higgins there, Chief Investment Officer at Coutts. Now, coming up, as some of the world's biggest ETF providers are accused of falling short on climate change, we'll ask if passive can also go green. That's coming up shortly, and this is Bloomberg.
Climate change is the defining issue of our time, so we've redefined how we cover it. With clear data and rigorous journalism, we rise to the scale of the challenge to reveal the breadth of possibility. We look at stories from every angle to provoke debate, spotlight solutions, and make sense of the greatest crisis of our generation. Bloomberg Green, solutions for a changing climate.
It is critically important that the markets stay open in this time, as opposed to trying to take breaks in the middle. I think that that'll just push off the situation a little bit, but actually could create other pent-up issues if you do close the markets.
This is Bloomberg ETF IQ Europe, everything you need to know about the funds and the flows. I'm Francine Lacqua. Now, the world's biggest ETF funds doing enough to tackle climate change. According to non-profit group Majority Action, BlackRock and Vanguard both voted overwhelmingly against resolutions that the campaign deemed climate critical. Well, let's get the story now with our Danny Berger. So, Danny, first of all, run us through exactly the criticism from this pressure group.
Francine, to sort of set the stage here, we have to keep in mind that BlackRock and Vanguard are the majority holders in many companies because they're massive ETFs and mutual funds hold a lot of these different firms. So in evaluating what sort of impact they had when it comes to things like proxy votes and voting for directors, Majority Action said that they simply don't take enough action. They said that they voted for 99% of the U.S. directors proposed for energy, utility, banking, and auto companies. So they wanted to see more movement when it comes to pressuring these different directors and pressuring the types of directors chosen for these different companies associated with fossil fuels. They also said that when you look at what they voted for in terms of different climate sort of proposals, they voted overwhelmingly against those types of things. Now, Majority Action, what they really want to see is for BlackRock and Vanguard to start pushing the companies they own for a zero carbon change, and they want them to put their money where their mouth is. You'll recall in January, Larry Fink announced that at the center of BlackRock's strategy would be a climate change response. Majority Action says they're not yet doing enough.
Danny, what do asset managers actually say in response?
So both Vanguard and BlackRock really emphasize that they are taking action. Francine, we have to remember it's difficult for these companies. They own hundreds, if not thousands, of different firms, so they have to sort through them in order to do this. Vanguard, as well as BlackRock, you can see they're really pushing for long-term value, and they say they continue to engage with company leaders. BlackRock saying something similar in terms of they are looking out for the value of their clients and the value that it brings for adding different ESG. They say that that means both engagement and voting. BlackRock also saying that they voted against 35 different directors when it comes to companies that are associated with fossil fuels. Again, that includes auto companies and energy companies because they simply weren't doing enough. Vanguard, for its part, also says that engagement goes further than just voting. It comes with conversations with the company, and they say they're also active in that space, Francine.
Thanks so much, our Danny Berger there. Now let's get some thoughts from Adeline Diab, from head of ESG investing for Bloomberg Intelligence, EMEA. Adeline, thank you for joining us. Can ESG ETFs really be green?
Hi, Francine. So, yes, ESG ETFs can be green, but there may be different shades of green. So there are two main types of strategies. The first one is ESG integrated ETF. So they would mimic the S&P 500, the Stoxx 600, but they do offer exposure to green. Our analysis recognizes that they're perfectly positioned for the green economic recovery because they're underweight energy and overweight materials and industrial sectors.
So, Adeline, talk us through a little bit about the process of how Exxon might actually end up in an ESG ETF. I think we've just lost Adeline, actually, so we'll get to Adeline shortly to have more of an ESG thing. I don't know whether we can go back to Danny to have a think about some of the ETF, of course, nuances when it comes to green and exactly what's happening. Now, we have some great leaderboards, and Danny was bringing us this story about the fact that actually, you know, despite why some of the banks or asset managers, including BlackRock, have been saying about climate change, they have been coming under increasing pressure from certain groups that they just have not done enough because they could have signed things. Interesting to see actually that asset managers have said that they will do more, but this needs to be really done in tune. Let's go back to Danny Berger to have a look at what else we should be watching in the space, Danny.
Yeah, Francine, if I can just touch back on this ESG story when it comes to these different asset managers. You know, I've discussed this story with both the folks at BlackRock and Vanguard. And as I was saying before, it really is a big task for them because they own so many companies and they need to sort through those companies. So just sort of give you an insight into how they actually evaluate it. Often what they do is they look at it in sort of a systematic way. They have various thresholds that they want these companies to meet. So if a company breaches those thresholds or aren't, for example, nominating enough people to their board, when it comes to diversity projects, that's when they'll really step in. So if honing in to sort of individual companies, they simply often don't have the manpower to do so. So that's why Majority Action noted that 99% of the time they voted for the U.S. directors that were proposed. A lot of times it's because they simply don't have the resources for all of the companies they oversee to be very, very active. Now, again, Vanguard saying here they backed 4 resolutions out of 36. BlackRock backed 3 out of 36, according to Majority Action. And so that is sort of, again, when they are able to actually step in and take an active role, they often will. But it's just so many companies that they oversee, Francine, that it certainly can be difficult to do so.
Danny, thank you so much. Danny Berger there with the very latest. Now, there's something else also that we've been watching in the ETF space, and this is, you know, some of the junk bond exchange-traded funds. And I think over last week, we saw some outflows as, of course, these high-yield spreads actually jumped at last. We do have a great chart for that, so we'll bring it to you after this. Now, that's it for this week's Bloomberg ETF IQ Europe. We'll be back with more. Of course, it's Wednesday, and that's at 9:30 a.m. London time. This is Bloomberg.
Another day of risk off across the financial markets. We bring you special coverage of all the price action and implications here on Bloomberg Television.
Hitting pause, Goldman Sachs, HSBC, and now Citigroup all tell staff in London to work remotely, reversing course after the UK government appealed to Britons to head back home if they can. Temporary powers. The ECB's Yves Mersch says the central bank risks legal trouble if it tries to extend crisis-era flexibility to its regular bond buying. And Battery Day with no sparks, Elon Musk disappoints as Tesla fails to unveil any major innovations, but it does promise a mass market by 2023. Well, good morning, everyone. Welcome to Bloomberg Surveillance. I'm Francine Lacqua in London, Tom Keene in New York. Tom, our other top story is actually just moments ago, we found out through our own reporting that JP Morgan is looking to move about $230 billion in assets to Germany. This is in case that actually they don't get passporting rights when renegotiating with the EU, because we're coming to the end of the Brexit transition. But if they do transfer these $230 billion, it would be one of the top 10 banks in Frankfurt.
Well, there's huge symbolism here. I mean, this is separate from the pandemic debate. This is a Brexit debate almost. But I agree, Francine, there's a huge, huge symbolism. When you line up the 5 banks above JP Morgan in Germany, they clearly have a European heritage, and they're the lone American bank.
Yeah, absolutely. We'll have plenty more on that, because you're right about the symbol, and if others will follow suit. Now let's get straight to Bloomberg. First word news in New York City. Here's Ritika Gupta. Hi, Ritika.
Morning, Francine. Tom. Prime Minister Boris Johnson is warning there are difficult months to come for the UK. In an address to the nation, he appealed to Britons to obey the new restrictions and work from home where possible. The tightening of rules comes alongside tougher enforcement and higher fines. Earlier, he told Parliament the restrictions could remain in place for 6 months.
And to those who say we don't need this stuff and we should leave people to take their own risks, I say these risks are not our own. The tragic reality of having COVID is that your mild cough can be someone else's death knell.
President Donald Trump's plans to replace the late Justice Ruth Bader Ginsburg are gaining momentum. Republican Senator and Trump critic Mitt Romney says he supports moving forward with a confirmation vote. That all but quashes Democrats' hopes of stalling a nominee until Inauguration Day. President Trump plans to announce his pick on Saturday. And the U.S. House has passed a stopgap funding bill to keep the government operating through December the 11th. That's after a deal to provide aid to farmers and food assistance for low-income families. The bill now goes to the Senate. Its passage would avert a government shutdown just before the November 3rd elections. Global News 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Francine, Tom.
Ritika, thanks so much. I can't convey enough, folks, the shock of what the Prime Minister said yesterday about shifting to March of next year. That will clearly be my theme through the day, including speaking to Richard Clarida. And you see it immediately in the data this morning, with equities up 17. The safe haven is convoluted, to say the least, with gold plunging $18.86 the ounce, now down $22 in the short term, and dollar stronger. The story here of a complete reversal in the weak dollar belief, 94.04 on DXY. Sterling was a 126 handle moments ago. That gets your attention as well. It is a most interesting market, Francine.
Yeah, it is. So I'm looking at European stocks, they're rebounding. I'm also looking at dollar extending some of the rebound that we saw, treasuries edging higher, and then I'm not actually seeing much, to do with euro, but we did have a good interview that our Paul Gordon brought us with Yves Mersch, saying that actually he's worried that, the ECB must limit their emergency powers to temporary crisis, because otherwise they'll get in a spot of legal trouble. So it hasn't really moved euro, but something to keep an eye on. And then gold, as you were saying, slipping below 1,900 an ounce, Tom. So joining us to talk about these markets, but also to talk about what we heard from the ECB and the legality of how to deal with future crises, we're joined by David Riley. He's Blue Bay Asset Management Chief Investment Strategist. David, great to have you on the program. I want to kick off with the ECB because we had this, pretty punchy interview with Yves Mersch, of course, all of his legal background, ECB executive board member, basically saying that, they would get in legal trouble if they tried to extend the emergency powers of the pandemic bond buying plan. What does that mean? How much does it actually limit what the ECB can do from now on?
Well, I don't think it
is a near-term challenge either for the ECB or for the market. As we know, the pandemic emergency purchase program has been extended to the middle of next year. I think the market is expecting that it will be expanded and certainly extended through to the end of 2021, and that those comments do sort of challenge that. But I think also we had a blog I think a little while ago from Philip Lane, the chief economist, who suggested that even as the pandemic came to an end, and hopefully that is the case by the middle of next year, but that's still a pretty big if, then the legacy and the scarring and the economic impact of that would potentially persist beyond the virus, and that would justify continued pandemic-related and emergency support. So I don't think this is really suggesting that the ECB is completely sort of boxed in, and I think they still have some room for manoeuvre. But I think it is highlighting that there is a debate going on, if you like, between doves and hawks on the ECB Governing Council. We are getting a bit of mixed messaging coming from different members of the Governing Council.
David, what do you do with UK assets right now? So, it's very clear that banks here in London have halted a return to the office. We saw also, and that's COVID related. And then we have this, other Brexit news that JP Morgan is said to move $230 billion in assets to Frankfurt because they worry about passporting rights.
Yeah, I think the outlook for the UK has looked pretty poor for some time. The UK economy is going to contract by around about 10% this year, so it'll be one of the hardest hit by the pandemic from an economic perspective. And part of that, I think, is because the UK economy wasn't in particularly good state coming into this crisis either. And then, as you've alluded to, Francine, obviously there's the Brexit concerns and the shift of assets, which is sort of reinforcing what we've been seeing more generally, which is that banks have been shifting large parts of their balance sheet to Europe, and we've just seen that announcement by JP Morgan. The other news, which was recently reported, I think yesterday, was that, for example, UK 7,000 UK haulage and lorries, don't have the paperwork in the event of a lack of a trade deal to actually be able to ship goods and ship goods across the channel into continental Europe. So, it's hard to get sort of bullish about UK assets. The FTSE is a sort of deep value equity market, and sterling, I think, has got plenty of room to get meaningfully weaker if we don't have, progress in terms of negotiations on Brexit, and the deadline for that is coming up over the next several weeks.
David, Tom Keane in New York. Good morning to you.
Morning,
I found
Tom.
yesterday to be a seismic change. None of us have really framed out to March of 2021 with this pandemic vaccine. How does that change your portfolio management to know that we will have challenged as economies without fiscal stimulus out to March of next year?
Yeah, good question, Tom. And I think what it's done in terms of our thinking, which has been something we've been debating a lot within Blue Bay and our investment committee, is that at what point do you start moving more decisively into what is a so-called reopening trade? So a sort of return to normality trade, where you look at some of the sectors, some of the names in transport, airlines, in leisure, gaming, in hospitality, the hotels, etc., which actually, haven't really, obviously have lagged the broader rally in markets that we've seen, and where, potentially there is a lot of value to be had if we get a return, as and when we get a return to sort of normality post-pandemic. And what yesterday's announcement kind of reinforced by the British government, but I think will become more widely recognised across the Northern Hemisphere as we go into winter, is that that's not happening anytime soon, and that's at least another 6 months away. And so it's actually too early to really go into that kind of reopening trade. So that means, we're staying with the things that we like, which tend to be more defensive, tends to be higher quality, tend to avoid the most COVID-affected sectors.
Are you bringing in duration on bonds? I mean, to me, it's fascinating how you make the bond call here versus what we heard from Prime Minister Johnson. Do you bring in duration?
I mean, actually, we don't have a large sort of active duration positioning across our portfolios at the moment. We have a small bias across our strategies where we have been long duration.
Well, we get some audio challenges right now with David Riley. I can't tell if that's my ears or his equipment. We'll see about that, but we greatly appreciate it with David Riley. We'll try to get that fixed here in a bit. Futures up 17, Dow futures up 211, sterling with a 126 handle comes back up sharply, 127.25, but nevertheless weaker, and you heard David Riley speak there of a weaker sterling. This is an exceptionally important moment. Our conversation with the Vice Chairman of the Fed at the 8 o'clock hour, Richard Clarida, on a robust evolution. This is Bloomberg. Good morning.
The scale of the climate crisis is just staggering, but you can't let that be an excuse for doing nothing. So to fight climate change, we can't be overwhelmed by the seeming impossibility of the task at hand.
Inclusive multilateralism is about bringing more voices to the table, resulting in more ideas, more solutions, and more climate action.
As a signatory to the Global Covenant of Mayors, Charlotte has joined thousands of cities and regions in a commitment to accelerate ambitious, measurable climate and energy initiatives.
Local communities across our nation are stepping up in unprecedented ways to respond to the ongoing challenges of our climate crisis.
We'll see what is the cost, what is the reliability, but without innovation, a lot of innovation, we won't be able to get there.
Some things you see coming, some things you don't. The trick is to be ready for anything. Pablo from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
Likely that more fiscal support will be needed.
I think the next package should be much more targeted. It should be focused on kids and jobs in areas of the economy that are still hard hit.
The recovery will go faster if we have both tools continuing to work together, as they have so far. I think worked very well together.
We're inclined to allow for additional flexibility on the money that's already gone out to state and local governments.
We need to reopen the economy so people can go back to work, and we need to do it in a sustainable way.
An important conversation the Federal Reserve Chairman and the Secretary of the Treasury made more important by what we saw across the pond from the Prime Minister of the United Kingdom. If there is a pandemic and if it is extended, what is a place of fiscal policy? David Riley is with us with Blue Bay Asset Management. And David, I want to get out front of our conversation with the Vice Chairman today. Fiscal policy to the rescue. Let's begin with the United Kingdom and the urgency there. Do you have any optimism that you'll see fiscal relief extended within the United Kingdom?
Well, it does seem that the UK government is now at last considering measures to either extend the existing job protection scheme, the furlough scheme in the UK, or introduce a sort of short-time working wage subsidy scheme, which is of the kind that we see in countries like Germany. I mean, they have left it very late because in the UK, the furlough scheme, so the sort of support for comes to an end at the end of October, but actually typically companies, if they are to lay off workers, will have to give something like 45 days notice. So I think right now companies are having to decide if the furlough scheme is coming to an end, we are going to have to start providing some redundancy notices. So the government is really running out of time, and I think they need to make an announcement sooner rather than later.
What does the yield space tell you and tell our central bankers about the ability to reflate? I mean, Vice Chairman Clarida has laid out the hopes and aspirations of a central bank to migrate yields higher with inflation higher. Do you see that?
No, I mean the market is deeply skeptical, and that skepticism is no greater than in the bond market. That central banks can, including the Fed, get inflation not only to their target, but actually for a period of time moderately above their 2% target. And that skepticism was a little bit reinforced at the last FOMC meeting, because the Fed doesn't forecast that they're going to get inflation above 2%, but they also didn't signal that any more policy action was going to be forthcoming. And I think they're waiting in part because they want to see what's going to happen in Washington, both in terms of the election, but also in terms of fiscal policy.
On the election, David, how will that actually move treasuries?
Yeah, that's an interesting question. I don't know whether I have an easy answer to that. I mean, obviously, post-election, it will depend on the electoral makeup. I think the presumption is that if there is a Democratic Party clean sweep of both Congress and the presidency, that will get a significant fiscal stimulus package. Other things being equal, that would put some upward pressure on bond yields. But I think that's kind of a little bit too far away. I think right now, what it is quite a meaningful source of political and policy uncertainty, and the deadlock we're seeing in Washington now around extension of our CARES 2. And I think that's one of the reasons why I don't think these markets are going anywhere. The central banks are still providing the backstop, but we don't have any kind of incremental policy stimulus to drive markets higher. And the economic news from here is probably going to be, if anything, on the disappointing side, as we've seen, with the European PMIs, marginally sort of disappointing. I think we're past the best in terms of the sort of recovery path.
But David, for example, in the UK, I mean, there could be an extension, I don't know if it's the furlough programs or some kind of wage support, but given that there's so many new restrictions to try and contain COVID, we are expecting more on the stimulus side.
Well, don't forget, there's effectively quite a lot of the stimulus is kind of running off, and so what we're expecting or at least anticipating is that the UK government will provide some further extension, but it's going to be probably a less generous scheme. It's probably going to be a less significant in terms of the amount of public spending. So I do think that and more generally, of course, within Europe, more generally, I think we have seen both Germany and France, and obviously with the EU Recovery Fund, a more kind of sustained and coherent fiscal policy response, which has been part of the kind of more positive narrative around Europe. But I think, fundamentally, we're in a situation where, the pandemic isn't going away. It's going to be around for at least another 6 months, even if we have a vaccine announced by the end of the year, where we're not going to get much more, at least in the near term, from the US in terms of fiscal support, and I think from central banks until the sort of end of the year. And a lot of the good news has been priced in terms of the recovery. So I think we kind of go sideways, and then the US election is potentially a big source of volatility for markets.
what is the language of negative rates right now? I mean, we get, David, what Prime Minister Johnson spoke of yesterday, which you just stated is 6 months without a vaccine. Do negative rates must happen, or could happen, or should happen? What's the language you would use?
Well, I think in the case of the United Kingdom, I think if there's no resolution and deal, dare I say that terrible word, on Brexit, or rather on the sort of post-Brexit EU-UK trade relationship, then I think the Bank of England's policy response to that would include negative interest rates. And I think that's where they're going to kind of keep their powder dry, if you like. It will be a rather desperate measure. I'm not convinced that it would be the right measure, but I think it's the way in which they would likely respond to a sort of no deal Brexit outcome. So I think they'll wait for that. But more generally, we're seeing other countries like New Zealand sort of debating the potential for going to negative rates. I do think that this underscores to your previous question, Tom, about where the bond market thinks we're going. It doesn't think that we're in an inflationary world. It's skeptical that central banks can meaningfully increase inflation, and I think the central banks, at some point, are probably going to have to provide even more in the way of support. And for a lot of central banks which are at or near zero in terms of their policy rate, then the next step would be to go into negative rates.
Thank you so much, David Riley, their Blue Bay Asset Management Chief Investment Strategist. And now the Bloomberg Equality Summit takes place with speakers from the business, education, sports, and entertainment worlds. The speakers include the former Xerox Chief Executive and Chairman, Ursula Burns, Carlyle Group Chief Executive, Kyu-Song Lee, and Bank of America Chairman and Chief Executive, Brian Moynihan. Well, coverage begins at 7 a.m. in New York. That's 12 p.m. in London. And this is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here? It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
There is no change in policy, but there is a lot to unpack
back in this Fed statement.
My sense is that more fiscal support is likely to be needed.
You saw definite signs of slowing. Do you still see that?
The amount of pain we're going to have in the economy and the challenges we face to get to a full, robust recovery are just going to be much greater.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Bloomberg Surveillance. I'm Rishika Gupta with your latest Bloomberg Business Flash. Tesla is setting the lofty goal of making a $25,000 car by 2023. The cheaper car will be possible by innovating electric car batteries and cutting the costs in half. The news came as part of the company's so-called Battery Day, but it lacked the sizzle investors have come to expect from CEO Elon Musk. And HSBC is joining Goldman Sachs in pausing its efforts to return to its UK office. That's after the government appealed to Britons to work from home to help combat coronavirus. The bank says critical workers supporting customers in branches will continue to do so, but that most staff will remain at home. And that is your latest Bloomberg Business Flash. Tom Francine.
Ritika, thanks so much. Equities, bonds, currencies, commodities. Equities lift right now. Futures up 15. Dow futures up 196. The VIX extraordinary from a 30.31 into 26.26. And sterling, Francine, you single-handedly have driven sterling stronger.
Yeah, I tried to. I do my best for online shopping, Tom, but actually sterling dropped to a 2-month low after we also heard from the Foreign Secretary that a second British lockdown cannot be ruled out. So we'll look at the markets. We'll also focus on climate change with a great new article. We'll be speaking to Mariana Mazzucato, UCL Professor of Economics. She's coming up next, and this is Bloomberg.
personally affected by the fire, direct family as well as extended members. We've had people who've had to evacuate themselves. And so it's kind of balancing out the management of our critical patients with just making sure that we can stay stable ourselves. This is just a lot for everyone.
Trying to reunite owners with their animals at this location. We're not sure exactly how long we will be here, and so we're attempting to make efforts to create some infrastructure and to make a more permanent temporary
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
We explore the trends, investments, and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe.
Bloomberg Surveillance. Good morning, everyone. Francine Lacroix in London. I'm Tom Keene in New York. It is a tumultuous time, an historic 2020, and indeed, Prime Minister Johnson yesterday with a bombshell. What to do? It's real simple. Read The Value of Everything. My book of the year a while back. The Value of Everything is an extraordinary walk through the history of our certitude in economics and looking out at the hope forward and maybe possibly a measurement of our society. We are thrilled this morning Mariana Mazzucato joins from UCL. Mariana, there's so many things to talk about, including your important essay on climate change. I must get to the Prime Minister yesterday, who took the x-axis out to March of 2021. Are our societies prepared for the economic damage of a pandemic out another 6 months?
Well, you know, what we have to ask ourselves is also what we're learning crisis to crisis. You know, did we learn the lessons from the financial crisis? I'd say no. Are we learning the lessons from the current health pandemic? I'm not sure. You know, lots of public money globally has gone in for the recovery, and we're failing to actually structure those recovery funds in ways that actually really build stronger systems on the ground. And I, mainly mean health systems. It's not enough to be clapping healthcare workers. You know, it's very interesting to go country by country and see have we actually better resourced our healthcare workers, the healthcare system actually innovated within it, but also made sure that the recovery funds are, for example, conditional on both strengthening those systems, but also the underlying business model.
Mariana, look, the fabric of your book is on the back end. You talk about the economics of hope. Right now, the politicians are hoping. How do we do the hope of economics while providing income support? I don't see that in America, and it's even under question in Europe as well, isn't it?
Well, I mean, I don't just talk about hope. I talk about the need to rethink value. And, again, health is the perfect area because when you have a public health system where we only know how to value the input, so the costs, that's why we often talk about, the costs of healthcare. We don't see it as an investment for the future. And, this need to actually revalue what matters to make our economies more healthy, more resilient, to build what I think we should be calling a smart, healthy Green Deal. It's not even enough to talk about a Green Deal. It has to be a healthy Green Deal. That will make our economies more hopeful, but, hope on its own without actually changing the structures on the ground. So the business model, the corporate governance models, the structure of finance, but also government itself, which is just too much in the business of handouts, subsidies, guarantees, and kind of too little, too late. Is fixing one market failure to another. We actually have to be building, creating, co-creating. This isn't just about the state, co-creating with the private sector, shaping markets to be more inclusive, more sustainable, and definitely to be stronger so that when we actually get these crises, and there will be another one for sure, there'll be another wave, we can actually react in ways that are not too reactive.
Mariana, let me go to your piece in Project Syndicate, where you basically argue that the world may need to resort to lockdowns this time to tackle climate change. Now, you write, we need to move quickly if we want to transform the future of work, transit, and energy use and make the concept of a green good life a reality for generations to come. Now, one way or the other, radical change is inevitable. You say our task is to ensure that we achieve the change we want while we still have the choice. Mariana, I mean, what has actually held us back so far? It seems that, you talk about public-private partnerships, but do we have the right people in government to actually, make the bold decisions that you argue are needed?
So, I mean, it's easy to, just look at governments or even just to blame the private sector. What I do in the article and what I've been doing in my work now for some years is to pinpoint the actual changes we need amongst all the different economic actors. In fact, in the book, again, that we were just talking about, I talk about values being collectively created. Well, let's look at how it's being created. Let's look at the different actors. So finance continues to mainly finance itself. In the UK, where I'm sitting, something like 80% of funds go back to the financial sector and finance, insurance, and real estate. So in that sense, we're overly financialized in terms of how we have structured finance. Our business models, we can talk about stakeholder value all we want, but unfortunately, many companies continue to be very short-termist and focus mainly on rewarding shareholders. You know, the share buybacks continue to escalate at the expense of more longer-run investments, including in human capital. You know, we can talk about the robots are taking away jobs, but if we're not investing in the skills and people in those long-run investments to actually govern these transitions better, we're in trouble. And, you know, the figures are quite stark with the climate. So last year, the Intergovernmental Panel on Climate Change argued that we just have 10 years left, and yet in 2019, 10 years left until climate breakdown basically is irreversible. But in 2019, so just last year, subsidies to fossil fuel companies were estimated at something like $20 billion a year in the US and $55 billion a year in the European Union. And the COVID recovery funds allocated to energy companies by the G20 governments, something like 56% has been handed to fossil fuel projects, equivalent to $152 billion. So, you know, even just those numbers, and sorry if I just ranted them out, you know, doesn't make me think we're actually moving. So what we actually need is a new social compact. Yes,
so I haven't looked at the numbers, but if those are the numbers, then what's, you know, why? Is it difficult to try and, you know, is it difficult for the people that give out the money to see what they're investing in? Is it, you know, difference in priorities?
So let's focus on one. Yeah. Okay. So, I mean, there's definitely lobbies. You definitely don't need me to come on the show and tell you that. But let's just focus on the government side, since I'm sort of at least one of the people trying to change how governments operate. So, you know, it's quite striking that in a moment, just like again with the financial crisis, where trillions are being poured by governments into the system in order to stave off this crisis, to help, you know, people, businesses, everyone cope, very few countries have put strong conditionality. So governments putting conditionalities on transformation of the companies that are actually receiving the funds. In France, I must say, Macron was one of the most courageous, not perfect, but still he said, we're not here just to save or bail out industry, we're here to transform it. So the funds that, you know, Renault, the car manufacturer, and Air France, the airline got were conditional on carbon reductions. In Denmark, they were conditional on not using tax havens. Unfortunately, in the UK, we just gave a massive handout to EasyJet, no conditions attached. And unfortunately, it's more the latter that's the rule. So the first thing I would say is governments have to be much more courageous and actually remember that there's a deal. It's not just the green bit of the Green Deal. There's a deal, and we don't often have the right deals, and they have to be mandatory.
Let's do this. Let's come back with Mariana Mazzucato. So much to talk about these historic times, aggregate demand, a little bit light. Coming up later, of course, Richard Clarida. Right now, with our first word news in New York, is Ritika Gupta.
Thanks, Tom. Pressure is rising on UK Chancellor Rishi Sunak to set out how the government intends to protect jobs and businesses through the autumn and winter. The Treasury has spent over £100 billion on wage subsidies and business loans, but this is due to end in the next few weeks. Sunak has previously warned the current level of support is not sustainable. Fed Chairman Jerome Powell is calling for further support for the U.S. economy, saying it has a long way to go before fully recovering from the pandemic. He made the comments during testimony to the House Financial Services Committee. Prospects for another round of fiscal stimulus have dimmed in recent days amid tensions over a replacement for Supreme Court Justice Ruth Bader Ginsburg. President Donald Trump and Xi Jinping clashed during a virtual United Nations General Assembly meeting. The U.S. president used his speech to accuse Beijing of polluting the oceans and lying to the world about the coronavirus. His Chinese counterpart hit back, slamming leaders who tried to politicize the virus. Global News 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Francine, Tom.
Thank you so much, Ritika. We'll also be talking about Belarus shortly. Coming up in the next hour, Carl Bildt, the former Prime Minister of Sweden, will talk about Navalny and Belarus. That's coming up at 6:30 a.m. in New York, 11:30 a.m. in London, and this is Bloomberg.
Bloomberg Surveillance. Good morning, everyone. Francine Lacroix in London. I'm Tom Keene in New York. Futures up 16. Dow futures up 199. Watching sterling, a 126 handle now, 127.33, but decidedly weak over the last number of days. It is a spectacular book, like Richard Haas's The World. It is a required walkthrough of the history of economics in this case, with Mariana Mazzucato, The Value of Everything. I can't say enough about the book. And the secret here, folks, is like Lagarde from France over to Washington. Mazzucato has straddled the Atlantic. She grew up in Princeton, New Jersey, was forced at gunpoint to study physics by her father, and we're thrilled she could join us, even though greatly associated with England and the continent of Europe. Mariana, I want you to explain why income replacement or income relief is so difficult for all in the Western world, and particularly difficult for your United States of America.
Well, first of all, I didn't study physics. I wish I had. My father does nuclear fusion, and he argues that's the only hope we all have at some point. It's always 30 years away, though, so let's not go down that line. Right, income support. I mean, one of the really interesting things, in the UK, for example, were the furlough schemes where the government paid 80% of the wages of the people that were, forced to stay at home. It's interesting, again, to see that there weren't actually then conditions attached to make sure that once that scheme was up, people wouldn't be, fired right away. So I think with all these types of support, both the kinds that I mentioned before, to business, as well as these that are going more directly to citizens through wage support, we need to structure these recovery schemes in such a way that think of the after, not just the immediate. Otherwise, we just get kind of bandages. But I think you were also probably, I'm not sure, alluding to, the revival of the discussion around universal basic income. And I think that's absolutely right. We need to be making sure there's a floor underneath which people do not go. That's what civilization should be about. We should have some human rights, actually, making sure that people are not so vulnerable, especially around the gig economy. I think, again, one of the things that this crisis has highlighted is that working conditions really matter. And if people have, these very scanty contracts where, with basically no benefits, so as soon as things get locked down, their own life gets locked down, that doesn't work.
How do conservatives, whether they're voting for Biden or voting for Trump, how do conservatives learn to trust government to affect these programs?
Well, as I'm sure you know, conservatives love government as long as it's doing what they want. So this has never been about more or less government. We're talking about what kind. Even deregulation is a particular type of government. It's government actually steering things in a particular direction. And that's why I often say, let's always remember economic growth has not just a rate, but a direction. Let's talk about that directionality head on. So an ultra-financialized form of economic growth, which definitely the U.S. has had, that was very much a cause of the financial crisis back in 2008, that required a lot of government activity to move it towards a financialized form. So really what we need to be talking about, especially during Climate Week, and also the year that it's the 75th anniversary of the United Nations, which is very much talking about climate this week, we should be talking about, if, big if, we want a green transition and a more sustainable form of growth, a more inclusive form of growth, but also an innovation-driven form of growth. What are the types of private and public investments that we need? And this notion that government is just there to fix market failures, set the rules of the game, and then get the hell out of the way, doesn't work. We would not have had any of the technologies in our iPhone, my previous book, The Entrepreneurial State, had there not been direct, active, strategic public investment in the internet, GPS, Siri, touchscreen display, all those things that make our smart products smart and not stupid.
Mariana, I want to talk a little bit about Italy because you're helping the government to try and really reshape the economy. So this government, right, the Giuseppe Conte government, has never had as much. I mean, no other government has had as much cash as this government has, enough possibly to transform this economy. But if the money is spent unwisely, it's not going to do that. So, how do you spend? You need to not support the old jobs, but actually create new ones, and this becomes tricky, right, for a government to put in place.
Yeah, well, tricky is a euphemism, but it's a good word. So first of all, yes, I'm a special advisor of Prime Minister Conte, and it's been a fascinating time because just for your viewers, those who don't know, this is a very exceptional time in Europe because before, when the European Commission released kind of recovery funds, alongside the famous Troika, they were often conditional on the member states, the countries in Europe, having to promise that they would cut their deficits. This is the first time that actually the conditions around the next generation EU recovery funds, the total amount of recovery is about 2 trillion euros, but the next gen EU is about 800 billion. That is going to be conditional on investments. So countries actually have to come up with plans around especially climate and digitalization in order for these funds from Europe to be released and land within the countries. And so I'm helping Italy come up with their own climate and digitalization plan, as well as health, but building on actually plans that, if you want, already exist, but actually giving it more substance, more framing, also an overarching, what I call a mission-oriented approach, because I worked for 2 years, I think you know, with the European Commission to redesign some of their innovations funds to be less dispersive and to be more mission-oriented. So, for example, having a mission around the future of mobility in a country or carbon neutral cities in a country is going to require lots of investment across many different sectors, as different as transport, real estate, construction materials, nutrition. And the real issue, coming back to also Tom's question before about government's capabilities, is how do we actually redesign the tools on the ground, the leverage that governments have with procurement policy, which, by the way, procurement budgets are huge, procurement, grants, loans, subsidies, to crowd in bottom-up solutions to foster experimentation towards these public goals. And you could call them moonshots. I'm not a fan of the word moonshot because it tends to look like a siloed project, whereas missions, if you think of what got us to the moon, that was a lot of activity across public, private, many different sectors and systems were needed.
Mariana, our mission is to go to break. That's what we do on television. Mariana Mazzucato, thank you so much. The value of everything, I really can't say enough about it, of course, with UCL in London. We've got much more coming up here this morning with futures. A nice lift up 19. I'm eyeballing it. I'm going to say Dow leading the way. That may change. We'll have to see. On Bloomberg Radio today, Noah Feldman on the uproar in Washington. On a legal basis, without question, our interview of the day. This is Bloomberg.
When everything around us, including the way we work and live, has been interrupted, uninterrupted service is peace of mind. Kimmy from customer support is responding to a 500% increase in daily call volume, no matter what. you can keep on.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is Bloomberg Surveillance. I'm Rishka Gupta with your Bloomberg Business Flash. JP Morgan Chase is moving about $230 billion from the UK to Frankfurt ahead of Brexit. The shift will make it one of the largest banks in Germany. With less than 4 months to go until the Brexit transition period expires, international banks have been beefing up operations in the European Union in case UK-based firms aren't able to retain passporting rights in a trade deal. Nike is bouncing back from its pandemic slump. The world's largest sportswear maker returned to profit for the quarter, posting far better revenue than expected. That was helped by growth in China and sales via e-commerce. Nike rallied in late trading, giving a boost to other activewear companies as well. And Amazon is telling Echelon Fitness to stop selling the Prime Bike, an exercise bike promoted as a collaboration with the company. The e-commerce giant says it's not an Amazon product or related to Amazon Prime, and that they're working with Echelon to clarify and change the product branding. No comment yet from Echelon. And that is your latest Bloomberg Business Flash. Tom Francine.
Ritika, thanks so much. Greatly appreciate that. We have had 4, 5, 6 once-in-a-lifetime events. That means it's a good time to speak to Nassim Taleb, of course, of Anti-Fragile, a wonderful, wonderful book. Our Eric Schatzker on the Fed with Taleb.
You can hear a lot of people complaining about printing money has, and the general process of printing money. And this, of course, I share their concern. But there's something few are seeing in it, and that's the anti-fragility aspect. That what is a crisis for? A crisis is there, just like a forest fire, to eliminate firms early that shouldn't be, should not be there, to accelerate the evolutionary process. So a firm that should go bust, early, should go bust now when the cost will not be high on their shareholders, on their owners, on the employees, on everyone. And you start it, so it gives you a chance, as they say in California, to start again and start again and start again. So you fail early. So that's a process by which those who need to fail, you do them a favor by allowing them to fail early. What the Fed has been doing is the reverse, is injecting tons of money to keep afloat firms that should not be around, and then delay that failure, because eventually it will happen, you see. Eventually they're going to stop doing that. And that's not part of the discussion. This country got strong because we had the highest rate of bankruptcy, you see, because there's a high rate of bankruptcy in America. And the rate of bankruptcy
You're speaking, of course, about the United States and not Lebanon, yes.
No, Lebanon has no problem. But in the United States, I forgot I was in a 12th century monastery here. So the United States, and particularly within the United States, the tech sector, has the highest rate of bankruptcy you can find. So by fiddling with this, plus the other thing is I don't know if I, on one of your shows, when we were discussing the election years ago and 4 or 5 years ago, and Donald Trump, and if I told you, listen, this gentleman may bring socialism to America, you would have never spoken to me again. Donald Trump is because I know it's COVID in its ways. Donald Trump is the first American president to do universal basic income, as you saw, and acquire stakes in corporations because the Fed bought paper. The fact that they did not or overtly buy stocks, is irrelevant. They bought paper from companies. If that's not socialism, acquisition of the tools of production and making sure everybody has an income, a floor income. I mean, these are some of the central aspects of socialism. So we live in a strange world today with and everything's driven by COVID.
Nassim Taleb there on disorder in this disorderly time. Of course, one of the great themes of his book, Anti-Fragile. He is at New York University in risk engineering. Futures up 19, Dow futures up 230. What we're going to do here as we get ready for our interview with the Vice Chairman of the Federal Reserve System is get an economic briefing. We're going to do that with Ian Shepherdson. Rumor has it also discussion on Newcastle. This is Bloomberg. Stay with us.
Everything around us, including the way we work and live, has been interrupted. Uninterrupted service is peace of mind. Juzi from customer support is responding to a 500% increase in daily call volume, no matter what. We keep on, so you can keep on.
This September morning, a pandemic reset as the Prime Minister looks out to March of next year. Barclays and other London banks, American banks in London, they will again abandon their London offices. Worldwide, the dawning reality that only a vaccine will end this nightmare. Foreign exchange, it prices a strong dollar. A 4 standard deviation surge this morning. Pound sterling pounded, gold under $1,900 the ounce. And the aspirations of Jerome Powell in the Fed. Later this morning, a crucial conversation with the Vice Chairman, Richard Clarida. Good morning, everyone. This is Bloomberg Surveillance from New York, from London as well. Francine, the linkage here of what we heard from the Prime Minister to what we're going to hear from the Vice Chairman today, to me, is just absolutely extraordinary. To me, the Prime Minister changed the global landscape yesterday with his view out 6 months.
Well, you're right, Tom. I mean, I guess it's, just interesting to have him hear it. I think there was no doubt when you looked at the, curves on the fact that there were more people infected by the day, that the situation was getting out of hand. And so the Prime Minister here of the UK, Boris Johnson, you're referring, of course, to the national address that he did yesterday, had to do something. What's even more interesting is that his foreign minister today said that actually you can't rule out a second lockdown. And so it'll be very difficult for central banks. And of course, on the fiscal side, what do you do with that? Do you give some kind of wage support? Do you try and change the economy in certain ways? It'll be a challenging 3 months ahead.
No, really front and center, and of course with Mariana Mazzucato in the last hour talking there about income support and the path to it. There is in the United States a modest issue of an election in front of it. With our news, extraordinary news flow, our first word news, here's Ritika Gupta.
Morning, Tom. Francine. Prime Minister Boris Johnson is warning there are difficult months to come for the UK. In an address to the nation, he appealed to Britons to obey the new restrictions and work from home where possible. The tightening of rules comes alongside tougher enforcement and higher fines. Earlier, he told Parliament the restrictions could remain in place for 6 months.
And to those who say we don't need this stuff and we should leave people to take their own risks, I say these risks are not our own. The tragic reality of having COVID is that your mild cough can be someone else's death knell.
President Donald Trump's plans to replace the late Justice Ruth Bader Ginsburg are gaining momentum. Republican Senator and Trump critic Mitt Romney says he supports moving forward with a confirmation vote that all but quashes Democrats' hopes of stalling a nominee until Inauguration Day. President Trump plans to announce his pick on Saturday. And the U.S. House has passed a stopgap funding bill to keep the government operating through December the 11th. That's after a deal to provide aid to farmers and food assistance for low-income families. The bill now goes to the Senate. Its passage would avert a government shutdown just before the November 3rd elections. Global news 24 hours a day on air and a Bloomberg Quick Take powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Francine, Tom.
Ritika, thanks so much. Equities, bonds, currencies, commodities. Equities with that lift off 2 days ago, was it 245? Up we went with a moonshot. We continued yesterday, and now futures up 19, Dow futures up 226. The VIX into a sprightly 26.16. Yields again, don't tell me too much story. A churn there as well. But in foreign exchange, interesting. A stronger dollar with gold plunging well under 1,900 the ounce. 1892 on gold and sterling. I'll let Francine talk about 126, now 127. But Francine, sterling, is pounded the right word for pound sterling?
It is. Sterling dropped to a 2-month low after we heard from the Foreign Secretary, Dominic Raab, that a second British lockdown cannot be ruled out. And I think maybe there's also a bit of extra pressure coming on Brexit, Tom, because we heard JP Morgan, just the latest bank, saying they just need to ramp up contingency plans because, we're coming at the end of the transition period and there is a fair chance now, this is according to people, of course, in the city, that they won't retain passporting rights in the trade deal between the UK and the EU. So they're actually putting quite a large amount, $230 billion of assets to Germany. We could see other banks follow suit, and so that may put further pressure on pound. And then overall, Tom, look, my data check is similar to yours. I'm looking at gold slipping below 1,900, and European stocks rebounding.
Very good. Yesterday, it was interesting to see. We're going to talk to Ian Shepherdson about Vice Chairman Clarida's comments later this morning. But first, on the fiscal ballet, the chairman and the secretary of the Treasury.
I think that it is likely that more fiscal support will be needed.
I think the next package should be much more targeted. It should be focused on kids and jobs and areas of the economy that are still hard hit.
The recovery will go faster if we have both tools continuing to work together, as they have so far, I think worked very well together.
We're inclined to allow for additional flexibility on the money that's already gone out to state and local governments.
We need to reopen the economy so people can go back to work, and we need to do it in a sustainable way.
The hopes and the prayers of the immediate for Mr. Mnuchin and Mr. Powell as well. Right now, we are hugely advantaged as we go to our important interview with Vice Chairman Clarida in an hour or two. with Ian Shepherdson at Pantheon Macroeconomics, doing brilliant global work, China work particularly, but also, of course, a day-to-day grind of the American economy. Ian, the great battle now, is Vice Chairman Clarida says, is what's called the ex-ante aspiration. This strange idea of reflating an economy and getting out front, trying to be patient, and not reacting to rising inflation until we get out there somewhere. Can they succeed at that aspiration?
I think they can in the medium term, but in the short term, we've got to get over the hole that COVID has blown into the economy. And what was happening until the end of July was that fiscal policy was doing quite a good job of covering over that hole through the enhanced unemployment benefits at $600 a week to everybody. And that stopped at the end of July, and since then we've seen the beginnings of a weakening in some of the short-term consumer data, and I'm getting very nervous that while we might have a reasonable idea of how things will look in a couple of years' time, I'm getting much more nervous about the next couple of months. And in particular, the fourth quarter, I think, is going to start off really quite weakly, and for retailers especially, you know, this is the busiest time of year. We're coming up towards Halloween and Thanksgiving, and then of course the holidays, which is when they make all their money, and it's going to be very difficult for them to make money if their customers are broke. And until or unless Congress acts, their customers will be broke.
And we certainly heard that from the Prime Minister yesterday. Ian Shepherdson, let's link the two together. If we get massive fiscal stimulus, if we get rising debt and deficits, does that then get us to a great reflation that Clarida speaks about?
Well, I think post-vaccine, I'm bullish about the economy. I think that growth will normalize relatively quickly. I suspect there's going to be a huge amount of untapped demand from people who've been prevented from doing the things that they like to do. But we're still going to have potentially really quite widespread damage and dislocation in the services sector in particular, where a lot of businesses are going to disappear without government support and will not be able to come back. And so to go from that normalization of activity to a reflation where we start to worry about upside inflation risks, I think that will take a lot longer. And that's the message from the Fed. I mean, they're saying loud and clear now that as far as they're concerned, the primary objective, the first order problem is to restore employment and growth in the economy. And we'll worry about inflation some way down the line. And I think that's the right approach. I think the wrong signal to give now would be that we're worried about the extra debt and we're worried about the inflation consequences of the pumping up of the money supply. That's a second or third order problem. The first order problem is the vaccine and dealing with the damage that it's done to the economy. And as far as I'm concerned, the Fed's taken pretty much the right approach. I just wish that Congress had acted earlier in the summer. I'm still hopeful, but not very hopeful, that they'll do something before the election, and that's why I'm so worried about the fourth quarter, because there is a void effectively emerging in consumers' finances, and it's a very big void, which is going to result in potentially quite a big hit to consumption, just at the time when, you know, we were hoping things would be really getting better.
But Ian, do you think, you know, governments would step up with some kind of extra support? First of all, when you look at, you know, you're saying that companies will go bust. Is this healthy companies that are going bust because of the virus? Or is it, you know, companies that were always a bit wobbly?
Yeah, this is not regular cyclical creative destruction where businesses that were struggling in the good times go bust in the bad times. So that's a normal business cycle at work. You know, if you can't take any wobble in the economy, then you're probably going to go bust when a recession hits. But that creative destruction is a normal, relatively healthy thing. This is not creative destruction. This is just destruction. It's virus destruction. And it's taking out businesses that otherwise were perfectly viable. We're facing no problems at all. We're doing very well. We're making money. Had every prospect of existing in the foreseeable future in a healthy state, and they've just been obliterated. Now, government action can limit that damage by effectively bailing out those businesses for the duration of the problem and keeping people in work, or keeping most people in work with most of their income, like a lot of European countries have done, and the US did until the end of July. But I think it's a fatal mistake to argue that that the damage that's being done now is just some sort of process that we would have expected anyway, and under the normal cyclical sway of things. It really isn't. This is a very much an out of the blue shock which even perfectly healthy companies in some sectors, consumer-facing sectors, can't be expected to deal with on their own. They're going to go bust, and we'll have a wasteland when we come back with a vaccine if we don't offer more support to those businesses in the meantime. And that, to me, is the first order problem that we face. And worrying about the public debt and the consequences for the longer term on the back of that is crazy. And it's like your house is on fire and you're worrying about the furniture getting wet from the fire hoses. Well, really, you should be thinking about the fabric of the building, the structure. That's what we need to support.
But Ian, just so I understand, I mean, given the environment that you're describing, and politicians are very well aware of it, and we had hints of that from the UK Chancellor, would governments in the next couple of weeks not do more to support this economy?
Well, I hope so. The UK government's tone has changed completely. I mean, Boris Johnson yesterday sounded serious for the first time ever in respect to the virus. The guy who was promising that everything will be normal by Christmas is now saying 6 months more of restrictions, and the Foreign Secretary is talking about the possibility of another lockdown. Now, against that background, I think the Chancellor's view has to change. And reading between the lines and listening to media, it does seem that he is now pushing for measures that will limit the damage to businesses. In the US, it's slightly different because, of course, it's up to Congress. So the president, the executive, doesn't have the authority on its own to go and spend lots of money, whereas in the UK case, with a large majority, the government can do pretty much whatever it likes. So we need Congress to act in the US, but now with the battle over the Supreme Court sucking up all the oxygen in Washington, the election just over 40 days away, the Republicans split on whether there should be a package and how big it should be and what should be in it, the Democrats having passed a huge bill in the House and going nowhere in the Senate, we have stalemate. And unfortunately,